Hello? Yeah, I think you can hear. Good afternoon, ladies and gentlemen, and welcome back. I hope you've all enjoyed your lunch. And we are ready to start with our next session. We're just waiting for one speaker to arrive, and we will start right away. The session is on financing future growth. And for this session, we have with us Shri G. Anant Narayan, whole-time member, SEBI, Shri C.S. Sethi, Chairman, SBI, Mr. Ashish Kumar Chauhan, Managing Director and CEO, National Stock Exchange, Dr. P.R. Jaishankar, Managing Director, India Infrastructure Finance Company Limited, and Mr. Amit Chandra, Founder and Chairman of India Bain Capital Private Equity. Chairing the session is Mr. Rajiv Memani, President Designate CII and Chairman India Region and Chairman Growth Markets Council, Ernst & Young. This promises to be a very, very interesting session, and I request you to all settle down so that we can begin as soon as our speakers are here. Thank you very much. Ladies and gentlemen, please join me in welcoming all our speakers for this session on financing future growth. As I mentioned, we have with us an absolutely brilliant panel, and they're joining us on stage. Request you all to please join me in welcoming them. Okay, Mr. Sethi will be joining us soon. And however, we will begin the session on time. And I'd like to begin by inviting Mr. Rajiv Memani, President Designate CII, and Chairman India Region and Chairman Growth Markets Council, Ernst & Young, to give his opening remarks and take the session forward. So.
Hi, thank you. Very good afternoon to all of you. I think it's a real privilege to moderate an exceptional panel. We have the leaders of one of the leading stock exchanges of the world, one of the most experienced regulators, CEO of one of the largest infrastructure companies, and also one of the most seasoned and experienced private equity investors. So it'll be an interesting session. Before, I thought I will just put some introductory remarks and then hand it over to the panel and then follow up with some Q&A. All of us know the Indian economy is in good health, not only in terms of GDP growth, but also in terms of resilience. So when we look at the overall debt, the health of the banks, institutions, corporates, the buoyancy in the capital markets, I think overall the health and the resilience of the economy is pretty strong. And most people, most financial commentators would agree that the economy is well positioned to grow at 6.5% to 7.5% over the next 20-25 years, which would mean that the size of the economy would go up by almost 5 to 6 times over the next 20-25 years. So, but to achieve that, one of the things that is critical is to see, given how the economy is transitioning, is how does the gross fixed capital formation, which is roughly 28% of GDP, that will have to move to roughly about 35% of GDP. And to achieve that percentage, a lot of that will also have to be done by the private sector. If you look at, especially over the last few years, a lot of the infrastructure investment, almost 40 to 45%, has been through budgetary support, coming through being led by the government. But as we transition, it will have to be front-ended by the private sector. And if we look at individual sectors, there was an announcement almost 3-4 years back. The pipeline for infrastructure investment is close to $1.3 trillion. MSMEs have a demand of roughly $1.5 trillion almost every year, out of which $300 billion is fulfilled by the formal system. Some of it goes unfulfilled, and the balance is through the informal systems or the other forms of credit. We need almost $250 billion a year to achieve and arrive at our energy transition goals that we have set up. So each of them have significant demands. Historically, India, if I look at last 20, 30 years, has funded its growth mainly through domestic savings. There's not that much of overseas funding that's come through. But gradually, as physical assets grow, and also there is competition for domestic savings from the government to fund the fiscal deficit, I think we'll have to see how we mobilize more savings into private investments, and also look at more foreign capital and see how FDI increases. And the savings are decreasing, and they're from roughly 20%, they have come to about 18%. FDI has been stagnant over the last 3-4 years, anywhere between 70 to 80, $85 billion. A lot of it private equity, almost $50-55 billion. And if you look at the India share in foreign direct investment, global share, that's about 2.5%. So not relevant to the size of the economy. The other piece in terms of how we look at mobilizing savings better is to see how we develop corporate bond markets. It is progressing, but the way our equity markets are buoyant or structured volume depth, we don't have the same in the corporate market. So both in terms of good quality paper that should be there, and also large pool of investors from a supply side standpoint, I think that has to be there. And also how we open it up more and more for insurance companies, for pension funds, both in India and outside. The other area is in terms of allocation of funds from especially if I look at the US pension funds, if we look at, they almost invest 50% of their capital in equity markets, about 20, 25, 30% in bond markets, and also about 15, 20% with venture capital funds. In India, depending on your vintage of pension fund, it could be anywhere between 50% to 75% with government, and also we have about, in terms of insurance, almost 50% has to be invested with government. So how do we open up that pool better will also be interesting. And then I think we will talk about sovereign wealth funds and other things, but we'll leave that to the panelists. My time is the red light is flashing, so I'll have to stop here. But again, I will we will kick it off, and I will request Mr. Anant Narayan, he's whole-time member of SEBI, for his address. Yeah, thank you.
Thank you so much, Mr. Memani, Mr. Sethi, Ashish, Dr. Jaishankar, and Amit. And thank you, CII, for inviting me to the second edition of the Global Economic Policy Forum. Rajiv was mentioning that some of us like coming to the podium and then we don't let go. I'll keep an eye on that timer out there so that I don't exceed my time. What I thought I'll do today is give you a regulator's perspective of this entire concept of financing future growth. What I thought I'll do is look a little bit to the back on one key feature which has been so instrumental in financing growth in the country over the last few years, which is the rise of the retail investor coming into capital markets. And I think it's a huge positive, even in terms of drawing in foreign flows, because of some of the advantages it brings in. From there, I wanted to segue into some of the opportunities and threats and challenges which go ahead in front of us, to make the point that there is absolutely no room for complacency to ensure that this capital formation happens and continues to happen. To start with, to remind ourselves, SEBI's mandate is largely threefold. It is investor protection, it is market development, and market regulation. Put together, our job is capital formation, to ensure there is sustained capital formation happening in the country. We are often seen as intrusive regulators with too many laws and too many regulations. That's not just our job. Our job is to ensure that a virtuous cycle of savers coming in, capital being raised, fresh capacity being formed, and therefore more savings coming into the cycle, that virtuous cycle actually ensues. And we have to keep reminding ourselves that capital formation is the cornerstone. Over the last few years, the ecosystem actually has done a tremendous job of drawing in fresh people into this capital formation cycle. March 2020, we had barely 2.2 crore unique mutual fund investors. Today, as of November, that number has crossed 5.1 crore investors. Likewise, in demat accounts, we had about 3.6 crore unique demat account holders as of March 2020. Today, that number has crossed 11 crores. It's about 11.4 crores. SEBI as a whole, we look at our ecosystem of individual investors who come in through mutual funds, PMSs, through direct investments in capital markets. The total number of unique individuals who were there at that point of time in March 2020, in some form or the other, was 4.9 crores. Today, that number is 13 crores. It's really grown. And this has been a fantastic story, and a full kudos to the entire ecosystem, whether it is exchanges, clearing corporations, depositories, mutual funds, AMFI, brokers, investment advisors, the entire ecosystem. All stakeholders have played their part, including policymakers and regulators. While this is about also how do you draw in, foreign money, I don't know if you realize this enough. This large amount of flow of retail flow coming in, investor flow coming into the markets, actually has had a stabilizing impact in the markets here. Quick, recollection, between October 2021 and June 2022, when Ukraine happened, when the Fed started to hike rates, we actually saw $36 billion worth of foreign portfolio investors going out of the country at that point of time. Any other time, such a large concentrated outflow would have created an impact in equity markets as well as in currency markets. Instead, during that same period, purely in mutual funds alone, we saw over $40 billion of fresh investments coming in seeking risk, which completely negated this outflow which was happening in the FPI market. So much so that in 2022, India was one of the best performing markets despite all these outflows going through. More recently, October and November, we saw $14 billion of FPI outflows happening over a short 2-month period. The inflow which came into mutual funds during these 2 months, seeking risk, was exactly equal to $14 billion as well. So we've actually had a fantastic stabilizing effect on the markets. The volatility of our Indian markets has been low, and that is a draw for foreign investors as well. Having said that, as I said, no room for complacency. There's a long, long path ahead of us. So a couple of points I want to make. While we celebrate the growth of the domestic investor, this does not mean we don't need foreign investments. We absolutely require foreign investments, the point that Rajiv also made. So make no mistake, we have to ensure that we remain an attractive destination to draw in savings from the globe so that we can fund our future growth as well. Second, going forward as well, we can't take this inflow of fresh investors for granted. We've got to make sure that we not kill the goose that's laying the golden eggs, but we also preserve it. And there's a lot of work to be done there on an ongoing basis. I'm going to quickly touch about some of these things. One thing which worried us as a regulator was this mismatch between demand for paper and the supply for paper that we saw till recently. In FY24, the year that went by, if you see the amount of demand for paper coming through mutual funds and through FPIs, that was far in excess of the fresh paper being issued by way of IPOs, FPOs, QIPs, preferential allotments, etc. The mismatch was around 3.5 lakh crores. So, and which was a kind of a record of all times. Now, the regulator is the last person to talk about valuations, but when you have such a mismatch between demand for paper from these real investors and supply of paper, the question of asset, inflation and sustainability, etc., comes up. This year, I'm happy to report to you that the supply is actually caught up. We now have a record level of IPOs, FPOs, QIPs, rights issues happening. It's already a record for the entire year, even though we're only sitting in December. So till November, we've seen about 3.1 lakh crore of fresh issuances coming in, which is a record for all years so far in the history. The beauty is it's also accompanied by the record of all years for mutual fund inflows seeking risk. That's already at 4.3 lakh crores. So we are into a good thing of actually these two things going ahead. But as I said, we can't take this for granted. We have to ensure that we don't, we nurture this goose that's laying the golden eggs. So what are we trying to do in terms of improving supply and making it more efficient? We can't really address the real economy, but at least in terms of our processes, we are trying to ensure that IPO processes are made more efficient. SEBI is actually using its own in-house large language models to actually, and training them to actually process DRHPs and even PPMs of AIFs, etc., so that the efficiency comes into the actual IPO approval processes. When we talk about the number of IPOs that we do in India, and we speak to our counterparts in IOSCO and other countries, our numbers are staggeringly large, the number of IPOs that we're actually going through, and that process will hopefully continue in that sense. The second big theme for us, which you will see a lot of us speaking about, is investor education and investor risk awareness. There is, again, something that all of us in the ecosystem, whether it's AMFI, whether it's mutual funds, whether it's brokers, whoever, everybody in the ecosystem has to ensure that's done. We are worried that with the number of young people coming into capital markets, many of them glassy-eyed, many of them who have not seen an investment down cycle or a capital markets down cycle, is there really adequate risk awareness in the ecosystem? So what we are doing, by the way, we're doing a lot of work through AMFI, through the exchanges, through the clearing corporations, etc. But beyond that, we're also launching this survey, which we intend to use. It's a very wide survey across the country, to try and figure out three things really. One, what does it take to get more people into the capital markets ecosystem? People who have fixed deposits, how do you get them inside? Is it about risk perception? Is it about awareness? Is it about access? What is it that will draw more people in? But it doesn't stop there. The next big thing is, how do you get them to be more risk aware? We want people coming in with their eyes open, not glassy-eyed and expecting to become millionaires overnight. So what is it? What is their level of risk awareness? Are they adequately informed about the risks and the volatility? And the third important part, what are the gaps as far as this inclusion is concerned, as far as this risk awareness is concerned? How do we communicate and bridge these gaps in the most efficient way? What language, what medium, social media, newspapers, television? So we're doing this large survey, which will hopefully inform our investor education and awareness programs going forward. The third area, which Rajiv mentioned briefly, which I want to talk about, now that there is so much of acceptance of risk in this country and people are willing to come into the capital markets, I think it's extremely important that products such as InvITs, REITs, Munis, etc., start to show some traction. And you will see a lot of efforts happening from SEBI to try and make this happen. Monetizing existing infra, existing capital can be a great way of actually ensuring that sustained capital formation comes through. And here again, we will do a lot on education. We'll require the ecosystem to do that as well. But I think there are some areas where the industry should reflect as well. Things like, for instance, valuation of assets. Now, this is not a regulated domain, and as I said earlier, regulators don't understand valuation. We should not talk about valuation. But making sure that things like valuation that there is no conflict of interest in doing the valuation, that there is sufficient disclosures of what's the assumptions behind the valuations, what is the range of valuations possible based on what assumptions you're making, and that there is sufficient accountability for your valuations, just as it is in the case of rating agencies. I think it's an area that we have to debate going forward. We don't want to get into regulating valuations, but if you want things like private equity, things like InvITs, REITs, munis, etc., to grow, I think that areas require some attention as well. Fourth, in terms of improving our efficiency, improving our transparency, reducing the risk in the ecosystem, we'll continue to work. Actually, our settlements and payment systems are the best in the world. Ashish is here. The market infrastructure institutions that we have are absolutely world-class. But there is still room for improving efficiency and reducing risk. One quick statistic. The amount of cash collateral or cash equivalent collateral from investors, from traders, from individuals, which is sitting in the ecosystem between intermediaries and the clearing corporations, is about 4.5 lakh crores on a given day, on average. It's like a mid-sized bank by itself. And it's lying not within the banking system, it's actually lying with either brokers or with intermediaries or with custodians and so on and so forth. Now, that gives rise to hidden costs. The reason why brokerage is close to zero is because you actually have float income coming from those balances lying with you. It also creates risk because after all, these are not banks. So while we have lots of checks and balances, don't get worried, we have lots of checks and balances, but we would still want to strengthen that. And third, it is not transparent. You really don't know what charges you're paying. Now, improving these things with things like optional T+0 settlement or the ability for you to trade by doing a UPI block on your balances in the bank so that you can trade against that, leave the money in the banking system, with having transparent brokerage or intermediary charges, which is in a competitive market, set perfectly in a transparent manner, I think can go a long way towards improving efficiency in the ecosystem. Finally, a quick one on FPIs, because a part of the topic was also FPIs. As I mentioned, we are working a lot to try and make life easier for investments into the country. We often get feedback that our requirements are onerous. We are starting to listen to that feedback. For instance, for one large category of FPIs, we've reduced the number of fields that they have to input while coming in for an application by 45%, by simply working with them to see what is it that is redundant and still meets all the regulations required. Similarly, we have a FPI outreach cell within SEBI, where we have spoken to more than 600 FPIs, where we are getting a lot of inputs on what we can do to make life easier for them. Finally, I want to quickly reflect on the session which happened prior to lunch, which was on regulatory, the point about regulations versus innovation. There's a lot of debate that often happens that our regulations, are they onerous, are they too much? I can tell you our thought process on how we approach regulations. We are mortally afraid of two kinds of errors. The first error is when we allow bad things to happen. So when a Harshad Mehta happens or a Ketan Parekh happens, that's a bad thing. The question automatically comes, what were you guys doing? Why were you asleep at the wheel? So that's a type 1 error which we always want to avoid. But we are equally conscious, I can assure you that we are conscious of a type 2 error as well, where our regulations become so onerous that they come in the way of good people doing their work. Now, it's a very, very tough balance. Statistically, it's impossible to minimize both type 1 and type 2 errors, but I think in regulations, it's possible. There are win-wins possible where you can reduce both these errors. And this is where we need a lot of consultation. We try to do a lot of consultation. We have advisory committees that tell us on every single regulation that we come out with or we propose. We have discussions around that. Every regulation that we propose is open for public consultation. Once it's done, we actually put it out as a principle. Then what it translates into as do's and don'ts for the people on the ground, even that we do a lot of consultation. So we try and do this in a consultative manner. My request to CII and all its members would be a part of this consultation process. It can be very troublesome. It can sound like a lot of work, but it's important that we kind of minimize both type 1 and type 2 errors. I see the watch coming down to the close. Very quickly, we've had a fantastic run on capital formation with the advent of the Indian investor. I think that trend should continue, but there is absolutely no room for complacency, lots of work to be done. to ensure that the risks are managed, education happens, people are risk aware, so that the sustained cycle of capital formation can happen. For our part, I try and assure you that we will try our best to minimize both type 1 and type 2 errors on regulation. Thank you very, very much.
Thank you very much, Nanta. I think clearly, I think the track record over the last 3-4 years in the way, SEBI and all the others constituents have worked has really enabled, as you rightly said, domestic capital formation, which has given a lot of resilience to the Indian economy. I'm sure we'll have a discussion on type 1, type 2. I think that's a very interesting point. I'll now give it to Ashish for his initial remarks. He's the Managing Director and CEO of National Stock Exchange, and also is a very key player in the way the domestic capital formation and also international has happened in India. So over to you, Ashish.
Thank you, Rajiv. Anand, dignitaries on the dais, friends, it's a pleasure and honor to be in front of you. Speaking after the lunch and also after the regulator, all your points have been taken. So while he was speaking, I was thinking, okay, all this data points are gone now, what do I need to speak? So I will try to still keep you entertained. In some ways, India is a unique country. Per capita income this year, because GDP data is actually what I call very low frequency data. Once a year, that also after the year is over, 6 months after that. It's extreme low frequency data, whereas what we trade in the stock markets is in microseconds. 1 second has a million microseconds. So we give you response in a millionth of a second. Of course, in next year, probably 25 or early 26, we'll give you response in the nanoseconds, which is 1,000 millions. And so that's where India is today in terms of infrastructure. But in some ways, a country with $3,000 per capita, or probably by this fiscal year, and you will see India had probably $3,200 or $3,300 per capita income. The economic theory says that a country with low per capita income cannot have a well-functioning capital markets for equities or bonds, because the poor people cannot save, and if they save, they don't trust even their brothers. How come a person sitting in, say, 2,000 kilometers away in Jammu or Srinagar or Dibrugarh or Jorhat, which are remote, not exactly remote, they are urban areas of India, but anywhere in the remotest part, today, NSE is present in all PIN codes without Jan Dhan Aadhaar mobile on its own. In all PIN codes except 30 PIN codes in India. There are more than 19,000 PIN codes. I have investors sitting in Andaman Nicobar. I have investors sitting in Ladakh, the remotest corner of Ladakh, and so on and so forth. And 30 PIN codes which do not have investors yet is because most of them are airports where nobody can give their address as a home address. But effectively, how did this market come about in India, which is anomaly? There is no similar market in the world at $3,000 per capita income per year. There is no similar market at $6,000 per capita income. There is no market at $12,000 per capita income. There is no similar market at $24,000. 8 times more per capita income and not a similar market, except one, which is China, where if markets go down, government A team has to go and do the buying. In India, do you think anyone buys here if markets go down? Why I'm telling you this is, this market is basically a market of the people, by the people, for the people. 77 years of independence and 30 years of NSE. NSE started operations on November 3, 1994. That time, India's market capitalization was 4 lakh crore rupees. That is, give and take few, probably $100 billion or $200 billion in that range. Today, after 30 years, it's $5.4 trillion. That wealth, which NSE represents today, with 10.7 crore or 107 million people, unique investors, is 1/3 of India's wealth. You take all gold, you take all real estate, you take all buckets and tumblers and everything, add up equities, and that is 1/3 of India's wealth. That wealth is the wealth of trust. That trust of an investor sitting in Jorhat or Dibrugarh or Andaman or Nicobar, putting her hard-earned 1,000 rupees, that is $10, into a company sitting in Salem in Tamil Nadu, they are never going to visit that company, but they have a trust that that promoter, that particular manager is going to make profits out of money I am putting, and then a leap of faith that if the profit is made, that person will not run away or not eat it up, but also give me my small little share of that profit. It's such a great leap of faith, right? India has become more trusting of its entrepreneurs. It is an unbelievable leap of faith that a poor country with per capita poor sort of $3,000 per capita income is still trusting its poor other entrepreneurs. It is unbelievable. Nowhere in economics, I mean, there are books written why poor countries cannot have good capital markets. Now, giving you the other side of it, that I give you a response time in microseconds, there is no similar market in the world. I'll give you response time in nanoseconds, there will not be similar market in the world. But on a good day, I get 2,000 crore orders. That is 20 billion orders in one day. 15 orders for every human in this country. In single day, in 6 hours, 15 minutes. 2,000 crore orders is slightly larger than UPI does in a month, 24 hours a day, 30 days a month, right? On a good day, we will receive 50% of all orders in the world. All exchanges put together. New York, Chicago, London, Japan, add their brothers, sisters, and we'll still be 50% of the world. People are investing in India's future. And that's why the topic that financing India's future, I have no doubt that if India is going to grow, it's going to grow on the back of the National Stock Exchange. So yesterday I was at TIE, the Indus Entrepreneurs Global Summit in Bangalore, and I said that if you don't get funded by private equity, venture capital, whoever they are, pension funds, come to NSE, we will fund you. Thank you very much.
Thank you, Ashish. I think clearly what the NSE has achieved in terms of sophistication using technology, I think even if you compare some of the settlement times between NYSE, NASDAQ versus NSE, I think the gap is already phenomenal and we continue to improve. I just want to over here recognize the presence of the Honorable Finance Minister of the Royal Government of Bhutan. Thank you, sir. Thank you so much for joining. Mr. Lenopo Leki Dorji. Thank you so much. And I was seeing that you were making all the notes. And I'm sure if you have any questions for all these gentlemen, we will definitely give you that the opportunity of doing so. I will now request Mr. Shetty just joined us as Chairman, State Bank of India. He just joined us. Welcome, sir. If you could make some introductory remarks from here or from wherever you feel comfortable.
Good afternoon, everyone. Thank you, CII, for giving this opportunity. I think when I was asked to be present on the panel here, I was just wondering what is that we can talk to global investors who are coming to India. And just for some of you who may not be familiar with SBI, SBI is the largest bank in India. And any number in India, of course, is large. We serve a customer base of 500 million. The demographics, one of the pointers which CII team mentioned is our customer base is a reflection of the demographics of India. Highly diversified customer base. We have 150 million financial inclusion customers who actually started the journey of banking with a zero balance in their accounts. And today, 99% of these accounts are funded as we speak, which means that the financial inclusion objective, which the primary objective of financial inclusion of having a bank account is tremendously fulfilled in this country. And that is where I think it's, both Anant and Ashish have spoken in terms of how this financialization of savings from the banking system probably is flowing into some of these other investment opportunities. The moment Ashish keeps talking about nanoseconds, I'm worried. It's already started, there's so much deposits flowing into the equity markets and SIPs. But it is inevitable in a maturing economy. We firmly believe that some allocation of the savings happens to this investment options. The way the bank like SBI has presence in every pin code, every village, every town, the way the investor community is spread out is a testament that this financialization of savings is happening. Important points to note is in terms of, I think, the financial ecosystem obviously is influenced by geopolitics, but I think India is very well positioned. During my interaction with several regulators, several countries, SBI operates in 29 different countries, and we feel that among many developed countries and developing countries, India is uniquely poised to be an investment destination. So that's on the demographic front as well as on the geopolitical front. And if you come to the productivity gains in the financial ecosystem, I think the tremendous work being done by the both banking regulator as well as securities market regulator is paying a rich dividend in terms of adoption of these new age technologies, including AI, not only for productivity gains, it is also in terms of the risk management. Today, huge customer base, and I'll just give you, I think, while Ashish mentioned about NSE's ability to handle transaction, the UPI, the digital public infrastructure which is created in India, has tremendously transformed the way the people transact today. On a payment system, on the maturity scale of 1 to 5, 5 being the best, I think it is one of the countries which is rated 5. And the direct benefit transfer, which is happening through the Jan Dhan accounts, the zero balance accounts today, our data indicates that 40% of this direct benefit transfer beneficiaries transact through the UPI. There's a tremendous adoption of the digital payment system. So this ecosystem of adoption of the DPI, proper regulation of the markets as well as the banking system, and the strong balance sheet, the twin balance sheet advantage of banks as well as the corporates, set a stage for India to attract investments. And in terms of the banking support for the growth of the economy, despite whatever challenges are there in the liability management, the banking sector is riding on one of the most benevolent asset quality life cycles today. The balance sheets of banks are strong and cleaner, and they have the ability to fund the growth prospects of this economy. And while the credit growth in many sectors is happening, I think the attraction of the renewable energy, again, which is another theme what is mentioned here in the sustainability front, both banking system as well as the corporate bond markets, I think, should contribute in terms of funding the sustainability initiatives of the Government of India. And Government of India is as committed for the net zero journey. I think is much ahead of the commitments what India is committed for. And we are playing, as the largest bank in the infrastructure financing space, our role in funding the infrastructure. And I think India continues to be a great destination for global money to come in. Thank you very much.
Thank you very much, sir. You're absolutely right. The twin balance sheet advantage today is a massive strength as we look at financing our future. Can I request Mr. P.R. Jayashankar, Managing Director, India Infrastructure Finance Company, if you can make some introductory remarks.
Thank you, Rajiv, and thank you, CII, for having me here. Good afternoon to all of you. Yes, the speakers before me have already outlined the kind of attractiveness that the nation has, before us, and the kind of transformation that is taking place today in India is definitely, one that is very, very significantly attractive for becoming a destination for global investors. And infrastructure sector, all, the subsectors included, the roads, highways, the energy, all forms of energy, and the connectivities, the ports, airports, and all the other urban transportation, sanitation, and urban development, and the latest forms of data connectivities, the data centers, and the renewables, all across the board, there's development. And the kind of projects that we have are all very varied, and the national infrastructure pipeline has been drawn. Perhaps India is the only country which has such a number of vast listed projects across, and very, very transparently in the website of the DEA. 10,000 plus projects, 160 lakh crores, and 25% of them are public-private partnership. They are in PPP modes, making India the number of projects, in terms of number of projects, being the largest, PPP exercise in the world. And if we look at the journey, I would say we are in the version 2 of the infra development. The version 1 was, all learnings. And today we are in this position with a lot of learnings and rich experience, developing the first public-private partnership projects, learning by doing. We always have, done the projects with the experience of the previous ones, and considerable success at that. And the risks, again, the risk management, if you look at it, from the version 1 of infrastructure development to the version 2 that we are in, that has been a paradigm shift, and with a lot of, lowering of the risks, with the great, impetus on development of concession systems, the termination payments, and a number of other factors, new models, new financing models. The hybrid annuity one was one which we had, and the InvITs, and so many other factors which have enabled the development. And today we are seeing a new asset class. The erstwhile infrastructure projects which were being developed in the last version is now, up for monetization, which offers a very, very good opportunity for raising resources, and the financial gap which is actually perceived in the national infrastructure pipeline financing of about 15-16 lakh crores can be met out of this monetization. So that is the present dynamics. And a lot of financial interests. Today we are seeing global funds and the global investors in this assets. There are 23 InvITs, which forms a secondary market, and providing that much liquidity to set the fundamentals more stronger. And with that, I think we are poised for the version 3, which would probably, be with more conducive regulations, more conducive structures, financial innovations. We have seen a number of innovations, financial innovations, so that, our concessions, which are today going at about maximum up to 60 years, 30 to 60 years, can go beyond that. The ones in the West, the Japanese lines, which are more than 100 years, the Channel Tunnel of UK, which is more than 100 years. All these things, we foresee the way forward with a very, very strong and robust banking sector, with the leading non-banking finance sector today in infrastructure projects, with their contribution more than 55%, with a good penchant for consumption, with very good economic structure. India is poised, and the world is perhaps witnessing a nation on the rise. So I think I'll stop at this, and we can take the questions as we move forward. Thank you.
Thank you. We will look forward to hearing the version 3. Amit, can I just request you to be slightly more provocative? Amit is the founder and chairman of Bain Capital. I think he mentioned he's got the most efficient market in the world. He said he's the best domestic capital formation in the world. He said he's the best bank. Infrastructure is under control.
I don't know about being provocative, but when you come out to give a speech like this, reminds me of middle order batsmen coming after Sachin, Sehwag, Dravid, Ganguly, and there's 500 on the board and you don't know what more you can do. So I feel a little bit like that. But one of the questions I was thinking of is, when I was coming out here, someone told me, you go to all these forums, does actually anything come out of it? And I think Anant's comments and some of the points that Ashish made reminded me that those of us who've been working at some of these issues for 2-3 decades, that a lot can come out of it. Because in the last 15 years, for example, we've seen a 5% decline in savings rate, and that should have actually hurt us. But if you see India is actually doing remarkably well. And I think one of the reasons that has happened is that during the same period, we've seen equity and equity-related assets go up from, to about 28% of financial assets, which is almost double of what it used to be. And all of that is for the reasons that both Anant and Ashish talked about. And that's, I think, incredibly powerful, and it's happened because of policy nudges. It's happened because of all ecosystems, players, coming together. And I think, what both of them said, that's had a remarkable impact on India. I remember when I used to run India's largest investment bank in the 90s and 2000s, FIs used to sneeze and we used to get a cold. But now it's, you can withdraw $10 billion in a month and we'll power ahead. Markets remain open. And it's not just that. It's also the remarkable wealth creation that happens despite whatever FIs do. And I'll just give you some statistics. Anyone who basically invested $100 in the stock market in 2008, that amount compounded today is 538 rupees. And that asset allocation number would have been very different if your behavior wouldn't have changed, because that number would have been almost half if it was in fixed deposits and bonds, which is what your behavior would have been earlier on. And this is, I'm not suggesting anything against Mr. Shetty's business, but, because asset allocation still needs to be broad and diverse. But this wealth creation has truly been awesome for India, because when we think of $5 trillion of wealth, with a very large part of it resident in India, it basically means that even with this decline in savings rate, Indians have had this cushion where we have been able to continue to go and spend on consumption and felt good about our lives. So I think we should not forget that what policy nudges and coordinated action can mean for all of us. And I think that's really, really important. I think kudos to the regulators, people in MOF, and all the ecosystem players who got together to make this happen. But I'll move forward, because we should always keep looking ahead and think about, 4 concrete suggestions that we need to think about for the road ahead. The first is, I think we need to really think about how we move insurance penetration up. Rajiv, something you and I were talking about just before this. We seem to be stuck for a long time in the 3 to 4% band. The world average is about 7. I think it's time we think about how we move from 3 to 4 to 7. I think this is important because we need a provision of long-term capital in this country. A lot of the capital in this country is still at the short end. It's really an imperative that we have long-term capital in India provided by Indians. For this, I think we need to think about policy nudges, particularly for the middle class and below, in terms of tax incentives. And I think the industry needs to maybe learn from the mutual fund industry, which has done a great job in terms of getting together and creating product awareness in a very neutral manner. So I think that's the first suggestion I have. The second is, we often forget how large EPF assets are. They're such a large percentage of our savings. Given how large they are as a percentage of the savings base, I think it's really a policy and a social imperative that we think about how we're going to deliver a fair return to savers from these funds in the future, so there is never the chance that they become a burden on the government. I think for this, we've started making the right steps in terms of thinking about raising equity caps. But I think we need to ask ourselves that, if foreign pension funds find great comfort in, high-yielding assets, equity, alternatives, credit assets in India, then we need to think about why should we not have greater comfort for our EPF assets as well. So maybe a more calibrated approach of raising these levels, because otherwise we'll have maramari in the stock markets. I think it's important for us to do that. My third suggestion relates to figuring ways to enable greater provisioning of long-term credit funding for infrastructure assets. I think we sometimes forget, and again, this is a point made by previous speakers, more infrastructure has got created in the last 10 years than maybe 30, 40 years before that. Now, there have been moves which, challenge infrastructure funding in India, particularly for Shettyji's business in terms of, the 5%, for example, provisioning requirement. I think it's really important that we figure how we are going to create a very stable framework for infrastructure funding in India. And I would suggest we do that both from domestic sources and international sources. For example, every year we think about, making tax exemptions for pension funds and sovereign funds. And right now we have one up to March. I think, people can't plan that way. So maybe we need to think about doing this for a 3 to 5 year basis. And importantly, we used to have in India, people participating in long-term infrastructure funding from domestic institutions and retail investors. We need to think about how to do that as well. And finally, I would like to turn to my own industry as well. Look, during the few years I was head of CII's P and VC committee, I began to actually grasp how large it had grown. It accounted for, as Rajiv pointed out, over 50% of FDI. And much of our celebrated startup boom, a very large part of the job creation outside of the conglomerates came because of investments funded by the PE VC industry. But I'm not making a plug for foreign capital, which I may represent. I actually think the time has come for us to shift to domestic capital. When I started my career in PE VC, 17 years ago, in China, it was China, which was the largest market outside the US, was completely dominated by foreign capital. Today, more than 90% of private equity raised in China is in RMB. That is staggering, right? Today, India's time has come in private equity. And India is perhaps amongst the largest and most important markets outside the US that investors look at. So question we need to look at, all of us stakeholders, be it policymakers, regulators, how do we create the most vibrant domestic private equity market? Now, this will be important because risk capital, just like the way we are no longer dependent on FIIs in our capital markets, we don't need to be dependent for risk capital on international investors. Just like the way wealth has got created, exceptional wealth has got created for domestic investors in our capital markets, we need to get wealth created for Indian investors in alternative assets. And this, I think, is very, very important. Time has come to start thinking about it. It'll be a long journey, but it took us, 20 years to get there. In capital markets, it will take us 20 years to get there in alternatives. I think the time has come. The policymakers are aware of this. I think they've done a very good job. There's a SIDBI fund, there's a SRI fund, SBI manages a fund for the government as well. So we know there are things that work, but it's time to double down on them. It's time to increase the scope. We need credit funds for MSMEs as well. And with that, I think if we really make a concerted effort, I have a feeling maybe we can shorten that 20-year horizon and do something spectacular in 10 years. Thank you for inviting me here, and my compliments for organizing a great event.
Very good suggestions, Amit. Thank you very much. What I'll do is, I don't think we have the time to ask individual questions. I'll put up some questions, and I would just request if, members in the panel, if they would like to respond. I think the theme is really financing future growth. Clearly, I think what we have achieved till now, especially in the last few years with the sophistication in the financial market, strength in the financial system, regulation and everything else, I think it's been quite, as I said, quite resilient, quite strong. But is it enough for India to be looking at 7.5% growth for the next 20, 25 years? And if capital to GDP ratio has to move up from 28 to 35%, government that's been front-ending a lot of the capex is on a fiscal deficit glide path. They want to sort of go down on fiscal deficit. They've been front-ending a lot of that. FDI, for whatever reason, has been it's stuck up at a certain level. So what is the kind of, what I would really want to hear, your perspective, whether this is enough, and Amit also mentioned savings rates have been going down. Is this enough? Is there something different that we need to do to be looking at financing the future growth? And any suggestions that any one of you have? I know Amit laid down a few of them, but if there are any other suggestions that you have in terms of ideas, suggestions, regulatory changes.
We are growing fast, no doubt about that. As compared to most of the peers, at least particularly in the Asian region, we have good economic structure. But if we have to continue this, and if we have to look at the kind of achievements that we have to, reach a level of GDP to get into the quantum of size that the economy deserves, that, the 30 trillion and by 2047 and all that, Viksit Bharat. Great deal of attention has to be there in the reforms. I think reforms from the real sector is one side, and the financial sector reforms is also, it has to be conducive to, the growth. From the real sector, I can say that today we have definitely progressed quite well, particularly in the last 5 to 6 years, as far as infrastructure sector is concerned, because infrastructure, I would say the multipliers, if you look at it, 1 rupee of spending in infrastructure can lead to almost 2.5 to 3.5 rupees increase in the GDP. So definitely, it powers the GDP. So if we need to look at the rear sector, which has the reforms which have progressed quite well, the transparency, predictability, and dependency of cash flows, that has been quite well defined so far. The kind of props, the kind of support that the government has given, yes, it has been more powered by the government financing so far. But the paradigm shift is very evident that we need to move. The reforms which are being put in place is all to make the private sector investments come. And this is all underway. The termination payments, the kind of changes that we have in the concession systems we have put in place, these are all, risk mitigant measures. And perhaps we have to talk something about the termination payment system, because having the largest PPP exercise in the world and having the road sector, occupy a dominant position in that, and a few other sectors which also offer termination payments, these are all again coming from the government's, budgetary resources. So this is again a big credit enhancement for the system that nowhere in the world, such a kind of push is there. Going forward, version 3, yes, I was coming to that we need to have financial sector reforms, particularly looking at non-banking finance companies, IFCs, infrastructure finance companies, with the same yardstick that is being applied to the non-banking finance companies in the retail sector is not really conducive enough. I think the regulator will have to take note of that and see that infrastructure-specific regulations can be applied into our economy as well, because there's a latest World Bank study which says 110 countries surveyed by the World Bank. I think this was out only in May 2024. Out of the 110 countries surveyed, 76% of the countries had infrastructure-specific regulations, and 56% of the countries surveyed had infrastructure-specific laws. So I think I think it's time for India to get these things in place, because predictability of cash flows, enforcement of the terms of contract, these will need to be served across the stakeholders' interest. I think these all have to, be put together. I think that will help, in getting more investor interest into this sector and the economy as well.
See, broadly, what you look at is that why do you require capital formation? Because it will create jobs and it will create growth, right? The framework, the way I look at it is slightly different, because the way we look at the economy is from the lenses of the rear view mirror. That it happened in the past, that's why it will happen in the future. Past is a good guide to the future, is a general purpose activities on all our mind. We think it happened in America, it happened in Europe, and stuff like that. But today there is a break. See, there are two significant sectors which have not been understood on the second part. The first part is what I call hard infrastructure, which is the ports, roads, airports, and every type of infrastructure, which including sewage lines. And so it helps you, at least there is a perception that will help you create more growth, more jobs, and other things. India is lacking in that. Hard infrastructure, India has been perennially lacking. And why? Is because we were capital deficit from independence and even pre-independence days, right? So we were not having that capital. We could not have invested. Now we are trying to make the hard infrastructure, all the ports and roads and whatever, at a breakneck speed, and hopefully in next 20, 30 years, we'll make that. The manufacturing part, which we think is going to create jobs. And it's not that today we are thinking. We have been, in fact, Baba Saheb Ambedkar wrote about it in 1920, about shifting the agricultural labor to the industrial labor, because that time there were no services. Why I'm telling you this, we have been investing tremendous amount of money in industry, and we'll continue to invest because there is still a lot of juice left. But walking in the footsteps of somebody will be me too. We need to have our own strategy. We have created those strategies, the PLIs, and also we have now got some great short-term achievements in terms of manufacturing iPhones and exporting them. And so for me, the manufacturing is the second part which guzzles capital. Third part is agriculture. How much capital we can put in, how many people we can replace from the labor into the agriculture, into other areas. And the last part is services, which also in some ways dovetails into the soft infrastructure. Today, our hard infrastructure is pretty much not that great, but our soft infrastructure is the best in the world in terms of the public private everything. Today, $2 a month gets you 1 GB or 2 GB per day downloads. Most of us use it for watching movies, but also we do transactions and other things, right? And so for me, the next future growth of the jobs and also what you said, 6.5, 7, for me, it can go to 8, 9, 10, because the technology is going to create that wealth much faster, because technology waves are coming faster, the wealth gets created by technology, and that's where the soft infrastructure, the country which has it, is going to create more digitalized assets, whether experiences, AI, and what have you. And for me, that is where India is best place, where you put in little meat and you get a lot of output. And that is why I call it non-linear outputs or non-linearity of payoffs vis-a-vis the physical infrastructure, physical manufacturing. They are in a way linear. You put in a lot of money and hopefully you will get a lot of money out. Whereas here, you put in little money, you get lots of money out. And we have so many examples of that happening in India. Say Infosys, very little money put in, now so many people are billionaires and many more millionaires and others. And that is true with Zomato and Swiggy and whatever you have. And that's why if you separately think of them, that services we are doing well, should we think that it doesn't require any investment at all? Or it doesn't require any nurturing or sort of exports and stuff like that? That's where for me, if we take all of that combined, we need to do investments in the infrastructure, in the manufacturing, and other things. But also, let's not forget services. And also, on top of that, the dematerialized services, the newer gaming and everything else that is going to come, which is going to create more wealth in the future, we need to also focus on that.
Yeah, I just want to build on a point, striking point Anant made during his remarks. And I think in that lies probably the biggest opportunity for India. You know, he said that they have cut, for example, in one process alone, 45% of the data that people had to provide to achieve the same process requirement that earlier on, SEBI required. I think in India, our biggest need is ease of doing business. If every department, state, or center, every regulator can basically cut its process requirements by 50%, and we can chop regulations by half, you will unleash such animal spirits in this country that all the people who are nascent entrepreneurs and all the people who basically are spending half the day running from pillar to post, filling forms, they will suddenly start becoming productive.
If I can just add to all the comments so far. First off, on savings, Rajiv, both you and Amit mentioned about savings being on the softer side. Incidentally, we are in touch with RBI and MOSPI. We actually have ground-level, bottom-up savings data in our securities market ecosystem, which doesn't require estimation, which is the norm in the other countries. So you will see some, hopefully, changes coming out in the savings number. But I think the larger point is it's very clear within the savings mix, the saver moving to investor, the capital market part of the savings is definitely on an upswing over the last few years. So I think the savers moving to investors are doing their bit for capital formation. So much so that frankly, as a regulator, our focus is on ensuring there is risk awareness, ensuring that people are not coming in with their eyes closed, and ensuring that a lot of money and time is spent on things like cybersecurity, information security, risk awareness, education, and so on and so forth. I think the time is now for the issuers. If the risk, if the investor is available now with the risk capital, we need issuers to step in and raise these funds now. We are seeing a bit of that. As I said, we are seeing record level of equity raising this year. It's a complete record not seen in the past, already 3.1 lakh crores. But beyond, and I want to echo what Mr. Jaishankar said, things like InvITs, REITs, munis, essentially monetizing existing operational capital so that you free capital for generating fresh capital. One estimate that we did within SEBI is that the total potential market size of things like InvITs, REITs, monetization of existing capital can be, the market cap of that can be as high as our GDP. We are a fraction of that currently. So I think doing the education, building the trust, making sure things like valuation, things like whatever it is that is required to build in the trust, and of course the larger education, so that these instruments for actually raising capital and then converting them into productive use, I think the ball is frankly in the issuer court, many of whom are here in the CII community. The last bit I want to add to what Amit said. I don't disagree that making sure that regulations are facilitative, as I said, the type 2 errors, reducing the type 2 errors, I completely agree with that notion. I'll tell you what our challenge is sitting in SEBI. We are, as I said, mortified by the prospects of both type 1 and type 2 errors. We get very nervous when we see lobbying entirely on type 2 errors or reducing them, turning a blind eye to what we see as very, very consequential, obvious cases of type 1 errors. My request to CII is the following. One, it's a very noisy world, particularly in this world of social media, where the amount of advice we get every day is just immeasurable. We have to sift through it. So you as CII, you could do us a great service and do yourself a great service by getting some degree of consensus and presenting what you think is a policy prescription to reduce the red tape and so on and so forth. Second, along that, please be a trusted advisor. Before we find out through our inspections or through some friends in the media or through some other intelligence that something egregiously wrong is happening, tell us it's happening. This is not snitching. This is purely saving the ecosystem. It's not a question of morality as well. I'm simply saying anything that goes wrong actually threatens the trust in the ecosystem, and the saver who's becoming an investor can be put off by that. It's a matter of preserving that ecosystem and not killing that golden goose. Please tell us if you see something, say something. So both of this, be trusted advisors, if you see something, say something, and advise us once you've gained the trust as a trusted advisor. Tell us what changes you would want. I'm sure we would be much more open in our hearing then.
Thank you very much. Excellent points. I know we have completely run out of time, but if for 2 minutes anyone wants to comment on bond markets. I know we have a very sophisticated equity market, but the bond market is relatively still not developed.
I wanted to say something about bond market. I'm glad, Rajiv, that you've asked that question. When we are talking about savers becoming investors, and much of this investments is not only happening in the equity markets, it's going to the mutual funds, it's going to the pension funds, it's going to the insurance funds. So I think we've been debating on the depth of corporate bond market for so many years, and we could never achieve that depth. I was just looking at SBI is the largest issuer of the corporate bond in the current market. And I'm sure that there are a lot of corporates would like to issue the bonds. We have issued about 50,000 crores worth bonds this year. But I definitely believe that if the savings, household savings, or corporate savings, are finding ways into these three investment categories, it is important that the pension funds, the insurance funds, and the mutual funds also actively participate in the corporate bond market. I don't see that kind of participation actively coming in. Even if it is coming in, it is coming near sovereign risk, or AAA bonds. And that is not really going to help in terms of deepening the corporate bond market. And eventually, even when you talk about the infrastructure financing, there's only so much the commercial banks can do because of the ALM mismatches or the ability to fund long gestation projects. So somewhere the corporate bond market has to come into the financing of infra as well as the balance sheet funding of the corporates. I think that's very much required. One piece of important enabler what RBI has given is for the banks particularly to put the corporate bonds into HTM category, held to maturity. But we still have been negotiating with RBI that even if I put in the HTM, I still have priority sector obligations on that, which means that it's going to really put pressure on us. And I'm sure, I think all of us have to really think how do we deepen the corporate bond market.
Thank you very much, sir. I think we need to now close. Can I have a round of applause for an excellent, outstanding panel? Thank you very much.
Thank you, Mr. Memani. May I request you to kindly hand over a token of appreciation to each of our panelists, please? And then we'll have a photo op and close with that. Post-lunch, the applauses should be. Thank you so much. May I request the panelists to please step forward and have a photo opportunity, please. Ladies and gentlemen, with that, we'll move on to the next. Right away, as soon as we've just turned the table around. Our next session, again, is a parallel session. So the session in this room is the geopolitical churn, the impact of global growth and India. And the parallel session is from India to the world, the GCC revolution. So for those interested in the other one, you can move to Shah Jahan Hall. And for the geopolitical churn, we have it in the Darbar Hall. Right here. So please remain seated. Some of you sitting at the back, can you move forward, please? Sitting back on the chairs, can you move forward, please? Nobody likes to have empty chairs in the front. It would be nice to have you all move forward. Thank you. Appreciate, much appreciate.
You know who is David is? I mean, recognize him.
Who?
David.
Yeah.
So because he has a presentation. So I have
Okay.
to hand over and to make him understand how to go next.
He'll understand,
So
but
can you give it to me or should I put it in?
no, I'll give it to him.
Let's just
But-
green for next, that's all.
Okay.
If you just tell them green for next. First you're calling him only on...
May I request our speakers for this session, Geopolitical Churn, the Impact on Global Growth and India, to please come up on stage. May I have Professor David Bach, Mr. Michael Every, Ambassador Arun Kumar Singh, Ambassador Anil Wadhwa, Mr. Shiv Siddhant Kaul. May I also invite the moderator for the session, Ms. Indira Bagchi. Please join us on stage. Ladies and gentlemen, can we have a round of applause and welcome them? Thank you so much. To begin this session, I'd like to invite Ms. Indira Bagchi, CEO, Ananta Center, India, to give her opening remarks and take the session forward. Over to you, Indira.
Thank you very much, and good afternoon, everyone, and welcome to our session on the geopolitical churn. as we all know, geopolitics is cool again. And if you just cast a cursory eye over the world, at this point, there are 2 active wars, one great power strategic competition, which may end up in a conflict, but it certainly will end up dividing the world in ways that we haven't even seen yet, and a new president. All very good ingredients for creating a churn of the kind that we may not have seen before. It's almost like a perfect storm. In a way, India is both part of this churn as well as being maybe in a position to exploit some of the opportunities caused by the crisis that we can see unfolding before us. I have a fantastic panel to discuss the issue, but let me begin by calling on Professor David Bach, the President of the International Institute of Management and Development in Switzerland, and the Nestle Professor of Strategy and Political Economy, to deliver his keynote address. Professor Bach.
Thank you so much. Good afternoon, everybody. It's a real pleasure. It's an honor to be here with you. Thank you to the Ministry of Finance and to CII for inviting us. As you just learned, I lead a global business school based in Switzerland with a campus in Singapore, a research center in Shenzhen, an innovation hub in Cape Town. And I'm very excited to be here with you, share some thoughts on the current geopolitical landscape and the enormous opportunity it represents for India. I think I have a couple of slides. I don't know if they're ready to be pulled up. And then once I have those, we can get started. Let's see if I get the slides. There you go. Okay, so current geopolitics and the opportunity for India. You see, I'm a professor. I need slides. I need to stand. I hope you don't mind. I wanted to start in the most recent crisis, of course, the events of the last couple of days in Syria. And the reason why I wanted to start there is because it highlights what is fundamentally the current state of global affairs. And that is that this event has surprised many of the leading powers, and they have had remarkably little influence over events. The United States has 900 troops in Syria, had very little influence over what happened. Europe has been a bystander, making statements. We've had some influence from Turkey, but very limited. Israel has tried to contain the impact on its borders, but has not been able to shape events. The same has been true for Iran, in many ways a major setback for Iran. Russia, Assad's other ally, has been unable to prop up the regime, and both China and India have been missing and are not expected to play a major role in shaping the developments going further. And of course, the newly elected President of the United States, or the President-elect, has made very clear that the US has no business influencing the future of Syria. This is symptomatic of what Ian Bremmer from the Eurasia group calls a G0 world, a world in which no major power is willing or able to exercise global leadership. Of course, the big backdrop here is the fact that the world over the last several decades have moved from one of US hegemony to a much more significant rivalry between the US and China. If you just look at global GDP over the 60-year period, US GDP as a share of global GDP has declined somewhat, but the big story, of course, is the dramatic increase of China's GDP as China has become part of the global economy. And if you look at that in terms of a ratio, you see actually that over that 60-year period, the Chinese economy, or the US economy, has gone from being about 35 times larger than China's, and still 10 times larger than China's when China entered the WTO, to now being only about 1.3 times larger than China's. And the narrative that I'm sure many of you are familiar with is that this is a story of rise and decline. I was in China 6 weeks ago, and still very much people describe the moment that we're in as one of great power transition. This image that you see here trended on Chinese social media a few years ago during the last Trump administration and the trade conflict at that time. And what you see at the bottom is a picture that shows negotiations between imperial European powers and Chinese negotiators, Chinese diplomats after the Boxer Rebellion in the early parts of the 20th century. And if you look carefully, you see on the screen a delegation representing the European powers that is youthful, energetic, smartly dressed, and they're sitting across Chinese negotiators who seem like they're 250 years old. If you look at the upper picture, that's the negotiation in 2018 after the Trump tariffs, and you see a Chinese delegation that is youthful, energetic, smartly dressed, and American negotiators who look like they're 250 years old. And so the narrative was very much that at the beginning of the 20th century, China was old and the West was vibrant, and at the end, or the early 21st century, it's the opposite. The West is old and China is vibrant. Of course, the situation since then, particularly as a result of the pandemic and recent economic challenges in China, has changed quite a bit. As a share of global GDP, US GDP is actually increasing. The US has been the fastest growing global economy, and China's economic growth, or at least China's share of global output, has stalled to some extent. And if you look at just stock market returns, you see that investing in the US would have been much better for your portfolio value than investing in a set of Chinese assets. Much of that has to do with problems in the property market, as you know, and the implications for the financial system. But I think more broadly underpinning this is concern about an aging population and the impact that that will have on the Chinese economy. And of course, those of you who travel to China regularly know that there's real concern about the confluence of a property crisis, a financial crisis, and an aging population. And of course, the memory is very much there, omnipresent, of Japan's lost decade in the 1990s. In fact, as you may know, some are beginning to wonder whether China's global might has peaked. If you take a step back, I think there's reason to be quite skeptical. If we look at three material sources of global power, I would point to military power, I'd point to manufacturing, and I'd point to finance. And what you see is a picture in which the US remains dominant globally in terms of military expenditure. It's slowed down a little bit or fallen a little bit as a percentage of global expenditures, but the US spends more on defense than the next 10 countries combined. If you look at manufacturing, China is the undisputed global hegemon in manufacturing, and of course that's where there is an opportunity for India as countries are looking for, and companies are looking for, diversified sources of supply. But when it comes to finance, the dollar remains hegemonic, whether that is in asset markets or when it comes to trade. And of course, the Biden administration very effectively used US military and financial power to prop up the Ukrainian government. But you have this situation where when it comes to these three principal sources of material power, the US is leading two, China is leading one. But the world that we're in is very much one where the US, despite its dominance in military and finance, particularly under President-elect Trump, isn't likely to exercise global leadership. China is dominating manufacturing and has a strong position in trade, but President Xi doesn't want to exercise leadership either. I'm based in Europe, and I can tell you the Europeans would love to lead globally, but they don't dominate anything, and so that makes it particularly difficult. So that's the challenging world that we're in, and of course folks have been talking about this as the ingredients for a new Cold War, but I think there's reason to be quite skeptical about this, and that's because the US and China depend on one another in a way that the Soviet Union and the US never did. If you look at total trade between the Soviet Union and the US, when Reagan and Gorbachev negotiated an end of the Cold War, is about $5 billion. If you look at global trade between, or trade between the US and China today, it is over 100 times that. So these two economies are very dependent on one another. And interestingly, much of the rest of the world, certainly the leading economies, are dependent on both of them. India is a very interesting example in that it is not nearly as exposed to China as many other economies are, but clearly much of the world is exposed to both of these two economies. So when you have this increasing rivalry between these two global economic superpowers, I would argue that that creates opportunities for others, particularly other influential or powerful countries. And in this audience in particular, I suspect many of you say, well, wait a second, we've been there before. There have been opportunities before for countries, for non-aligned countries, when there is conflict between two superpowers. But of course, this is a very different era from that in the 1950s when the non-aligned movement came together. And that's because of the global connectivity that I talked about before. The world is much more interconnected. Goods, finance, ideas flow much more freely. And that creates a challenging situation, one in which being non-aligned means being very conscious about your interests and leveraging them. I found this article by India's former foreign minister particularly insightful, how she explains India's decision not to take sides in the conflict between Russia and Ukraine with a very rational assessment that doing so would not be in India's national interests. And indeed, she follows in that statement, and I think Indian foreign policy more generally over the last several years follows very much in that realpolitik tradition that in the West at least is most associated with someone like Henry Kissinger. The Prime Minister certainly develops and maintains good relationships with the United States, but is equally comfortable with leaders of BRICS countries, and India has pulled off a remarkable feat being one of the primary economic beneficiaries of Western sanctions vis-a-vis Russia, something that would ordinarily make it a pariah in the West, and yet the opposite has happened as the United States has rolled out the red carpet trying to woo India, and in this particular case, strengthen economic collaboration and investments. So India has been very skillful in taking advantage of the current geopolitical climate. Now, all of that was before this man's re-election and his return to power. And if there's one thing we know about Donald Trump is that he's not driven by ideology. He's driven very much by an impulse to make deals. And I know in many national capitals, people are rereading his book, The Art of the Deal. And I think we can already anticipate a world over the next several years that is going to be shaped more by transactionalism, by deal-making, and that has implications for both global politics and global business. So where does that leave India? I think plenty of opportunities for India. India is already benefiting from companies and countries trying to de-risk their exposure vis-a-vis China. I know some are already predicting an Indian semiconductor industry that can reduce the world's dependence on Taiwan. But certainly there's a lot of excitement, there's a lot of enthusiasm about the opportunities that India represents at this particular critical moment. Now, I do have to close, or I'd like to close my remarks by just highlighting what some of our research at IMD says about the strengths of the Indian economy, but also some areas where development is going to be critical over the next several years. At IMD, we run a world competitiveness ranking, and we assess economies with over 250 variables in terms of their ability to create prosperity in the future. That's how we define competitiveness. And India currently ranks 39th in the IMD World Competitiveness Ranking. You see that many of the countries that rank at the very top there, including Singapore and Switzerland and Denmark, tend to be small, open economies. And India has made important progress in the World Competitiveness Ranking over the last several years. You see that right here. The general trend is positive and is up, but you can also see that there are two areas, economic performance and business performance, where India generally does better than when it comes to the role of policy, and in particular when it comes to infrastructure. So the story of India's recent success, certainly based on our indicators, is one where the private sector has been absolutely critical in driving economic performance. if you look at what business leaders appreciate about India, and this is an important part of our work, we do surveys among business leaders, both India and globally, about this, it is the fact that this is a country with a highly skilled workforce, a very dynamic economy, of course, at attractive costs, and more generally, the education level. Those are some of the things that stand out. But on the business side, there are also some really important opportunities, and I call your attention to the fact that when it comes to productivity and efficiency, India only ranks 43rd compared to, for example, the strength of the financial system. And when it comes to management practices, it is only 41st. So I wouldn't be leading a business school if I didn't say there are lots of opportunities here to work together, to strengthen talent, and to ensure that Indian enterprises have access to the best in management thinking and in management approaches to drive productivity. So if I were to summarize this and conclude, and I look forward to the discussion with my co-panelists, I think the opportunity for India at this moment is extraordinary. Your development, the incredible momentum here coincides with a geopolitical situation that is certainly complex and challenging, but affords extraordinary opportunities to India because of its status, because of its size, because of its momentum. At the same time, we have to be conscious that we are in a world that remains globalized, but without a whole lot of global leadership. And that means that pragmatism and interest-driven decision-making is going to be very important, I think, both in politics and in business. The Indian economy underpins India's global influence, and so the stronger and the more vibrant the economy is, and we've already heard this morning, the bigger India's clout is going to be. And of course, that is a story about continued investments in infrastructure and supportive policies, but it is also about the continuous development of talent in Indian businesses, in the Indian private sector, to make sure that India gets to write an exciting, a prosperous and inclusive chapter in the next story of its history. With that, let me thank you very much, and I look forward to comments and responses from my co-panelists.
Thank you, Professor Bach. We will now open this up for discussion in the panel. And my first speaker would be Michael Every from Global Strategist from Rabobank in Singapore.
Thank you very much. I agree with nearly all of that, so I don't know how far the debate is going to go. What I would like to add, though, is just a little context, which is just how radical and potentially how rapid some of the changes that we could see within the context just described are. Because I think while we all agree that Donald Trump is transactional, from the runes that I read, Trump 2.0 will be very different from Trump 1.0. When he won office, didn't know who to put in the White House and the administration around him, and while he had a mercantilist businessman's instinct, didn't have any ideology or how things actually worked. Now, if you look at the cadre of people that he's put around him, they have one very clear ideology, which is make America great again, or America first, which, while it's vague and vacuous and contradictory to a degree, does have a lot of core, strong, common points, which have a lot of potential impact. And what I think we need to look at are changes, not just in geopolitics, but in geoeconomics and geofinance, because since the end of the Cold War, which I'm old enough to actually remember happening, we've seen the emergence of one world central bank, which is effectively the Federal Reserve, one basically global borrowing cost. Dollars flow all around the world and everyone lends them on. So we all think in dollars when we're pricing internationally. Global trade, yes, is very integrated, we know that. But that's because dollar hegemony is based on the fact that the US runs the world's largest trade deficit with everybody, which benefits others exporting to it. That's your growth accelerator. Just sell to someone who sells to someone who sells to America. And America, of course, sends you dollars for that. That is one key point that everyone in the administration wants to end, one way or another. Now, can you end it overnight? No, absolutely. Can you end it without pain? That's a very big question. But they want to try and reindustrialize onshore or friendshore as much as possible because they see the current global paradigm as completely unsustainable. If it continues the way it is, America's vast military might will crumble away. Much of it was built at the end of the Cold War. The fleet is rusting. The cost of replacing a lot of it is just absolutely extortionate. They can't meet the goal of sending spare submarines to Australia, an ally that they've already pledged to them. They're in real trouble. So they need desperate reform to that. And part of it very much is going to run through trade. Now, if that happens, obviously everyone loses export opportunities to the US. There will be fewer dollars flowing internationally. You will see volatility and chaos in markets like you cannot believe, even if they begin to move towards it. But what I believe the Americans will do during that moment is not sit there blithely and blindly. They will be fully cognizant that that is what is happening. And they will, as we just heard, be looking at potential partners around the world and saying, look, we're still the biggest dog in the pack for now. We've got various tricks up our sleeve, from crypto and a potential crypto dollar, which maybe we'll discuss more in a moment. We've just had a breakthrough in quantum computing. We're the only ones with a functioning AI, which is really working. We may be on the cusp of developing AGI, artificial general intelligence, like in a science fiction movie. And we are prepared to roll our sleeves up and play dirty to get what we want. So here's a whole pack of tricks, or box of tricks, that we can play against you. And on the other hand, here's a box of candy. You can still have access to our markets. We can stabilize your currency with dollar swap lines whenever we want to make sure that you're completely macro stable. But the quid pro quo is, yes, you can run a trade surplus with us the way that you used to, but we want 100% alignment on this, this, and this. It won't be with everything. You'll have, free space to do some other things, and I think there will be give and take if America has any geostrategic intelligence. But it will very, very much, whose side are you on? Look at all the candy. Look at this nasty box of tricks. And I don't know how quickly we will come to that point, and I don't know how concretely we will come to that point. But the key point is, if they don't do that, if it purely is ad hoc, transactional, just playing around at the margin, a little bit on trade here, a little bit on trade there, which, let's be clear, the financial markets and the business community would love, because it's noise but not signal. Were they to do that, American hegemony is very much in trouble. You cannot be the primary military power without being the primary industrial power. You have to rebuild that with allies or solo. But if not, gradually that military hegemony will fade. And if it does, the global system will be in even more trouble than it is now. And the next iteration of this presentation will be even gloomier than one we've just seen, because there will be more countries than Syria in those headlines. So it's a dramatic way to finish, but I've only got 4.5 or 5 minutes to try and get it across to you. The scale of what we're about to see is far larger than most people can conceive, potentially. The speed at which it could happen is, again, something that we should be aware of after seeing Syria effectively disappear from the map in just 12 days. Thank you.
Thank you, Mr. Ivory. And I think that was actually a very important point about you cannot expect to be a military power without being an industrial power. It is something that I think we are thinking about that as well, and I think there is a lot of work happening in this country. May I now turn to Ambassador Arun Singh, former ambassador to the US, Israel, and France, to take this particular discussion forward.
Thanks, Indrani. I think based on what Professor Bach and Michael have said, just a few points. One, of course, it's said that businesses are happy when it's broadly an atmosphere of predictability and certainty. But when there is unpredictability, uncertainty, then more money can be made if you make the right calls. And I think we are going through that phase of unpredictability and uncertainty, and we have to be prepared for it. Also, it's been pointed out that we are in a phase of intense global contestation, even though there may not be a Cold War. And even if there's no Cold War, even if the US and Chinese economy are heavily interlinked, there's a clear message that US wants to maintain its preeminence and the technological lead. And so the US has declared that it's, although they are facing a challenge at the moment in Europe, their main economic, technological, and military challenge is China, which is the only country in the international system, both with the intent and capability to try and replace the role that the US is playing. And the US is now making a determined effort to push back on that. Now, the other element of uncertainty that comes in is that with President Trump coming in, he will probably make an attempt to bring to an end the active phase of the conflict in Europe. And if he's able to do that, certainly from India's point of view, that's a positive development, because then the India-Russia relationship would not come under the same adversarial gaze. Some of the sanctions on Russia would be removed. But then, will he be able to do that remains a question mark. Because in his first term, he tried to improve relations with Russia, but the US Congress blocked him by bringing in the Countering American Adversary Through Sanctions Act, where any major purchases that could be done from Russia would come under sanctions, because the US Congress sees itself as a co-equal branch of government. So President Trump has 2 years when both the Senate and House are going to be Republican, but what happens after that? So it's again something to watch. Also, if he moves positively with Russia, and if the European countries feel abandoned in this process, because from their perspective, they see whatever has happened in Europe as a direct security challenge to them. So if they see themselves abandoned in this process, then the transatlantic alliance would be weakened somewhat. And they would not go along with the US in terms of the strategy that the US defines towards China. Because the US needs European countries to buy in on the sanctions that the US is placing on China, like they needed Netherlands for the semiconductor sanctions. So the Europeans don't join the US on that, then the US strategy towards China will be weakened. So there is a lot of uncertainty playing out there. And if you look at the team around Trump that he has nominated, the national security team are hawkish on China. But the economic team that he has selected, the Commerce Secretary, the Treasury Secretary, somebody like Elon Musk with tremendous power around him, have huge investments in China, billions of dollars worth of investments and profits. And the expectation is that they would moderate his attempt to bring in heavy tariffs on China. So although initially he spoke of 60% of tariffs on China, the first threats he's done is 25% on Canada, 25% on Mexico, and 10% on China. So how this battle between the two factions, the national security faction and the economic faction, will play out is something, again, we have to watch, bringing in an element of uncertainty. Because even in his first term, while he was hawkish on China, as his national security advisor, John Bolton, has written, in a meeting with President Xi, he said to him that if you buy more farm produce from the Midwest states, I will moderate my stance on China. So there will be a transactional approach. So I think from India's point of view, clearly, while the language has moved away from globalization of trade and production to secure supply chains, friend-shoring of production, onshoring of production, we have to see what is the opportunity in that for us. And as the US does more onshoring in the US, they will also need to buy elsewhere. But I think the other big opportunity for us is the technology partnership. Because in the US, they have absorbed that if they want to maintain the preeminent position, if they want to beat back on the Chinese competition, they need a partnership with a country like India with 1.4 billion people, which brings tremendous human skilled capital to the table. One of the major semiconductor companies, for example, recently said that they employ 17,000 people in India, doing cutting-edge R&D and technology development work in one of their global capability centers. And the latest semiconductor design came out of India. 20% of the global talent for semiconductor design is in India. So the US also needs that partnership with India. And that's one of the reasons, for example, in January 2023, both countries launched this initiative on critical and emerging technologies. And following from that, there's cooperation in defense technologies. There's been cooperation in semiconductors, space-related technologies. So I think in addition to supply chains, a technology-based partnership leading to production sharing and leading to sectoral trading arrangements was something that we should be looking for. Thank you.
Thank you, Ambassador Singh. You talked about tariffs on Chinese entities, Chinese companies. I think that must be something that Indian companies must be watching out very closely for, given our levels of imports from China, and to see whether secondary tariffs are applicable on Indian companies, and that's something that would, economics would then be following geopolitics there. May I turn to Ambassador Anil Wadhwa, our former ambassador to Italy, Thailand, Oman and Poland, and to talk about how this particular geopolitical churn impacts all of us.
Well, thank you very much, Indrani. I think a lot of points have been covered about the international situation today and the uncertainties and the risks that are there around the world. We also have uncertainty in the United States and policies, what these policies would be going forward. But I would talk more in terms of India, and I think India to grow in future needs a situation around it and in the outside world which allows it to freely grow, to export more, to manufacture much more here in India, and at the same time employ its own people. So therefore, any uncertainty around the world, and that's the basic point here, creates situations where this would be retarded or would affect the smooth progress that the Indian economy wants to make. So if you take the Middle East, for example, and the disruption in oil supplies, for instance, or natural gas, if you look at the displacement that can be caused to Indian populations around the world, especially in the Gulf and the West Asia regions, or even if you talk about the supply chains and the sea routes of communication, which can be affected by turmoil around the world, that is a major risk that India has. In our own vicinity, over the past few months and years, we've seen turmoil. So, of course, we had a peaceful, relatively peaceful neighborhood till we have a situation now in Bangladesh, which has caused a lot of Indian companies invested in Bangladesh to also think very seriously about what kind of relationship this will be going forward. And at the same time, you have a neighborhood where you have an aggressive China in the South China Sea, but also growing in presence in the Indian Ocean, especially in the southern Indian Ocean and around India. So that creates its own dynamics. If anything happens in Taiwan, for instance, then that does also cause disruptions in supply chains as far as India is concerned, and its own options of trading freely with countries which are beyond the South China Sea, and also the other aspects of India's foreign economic engagement. So this creates its own uncertainties, but what is the situation in which India can cope with? Well, I think there are new opportunities, as was mentioned earlier, which have arisen as a result of the US-China rivalry. And we've been there before, as was mentioned by Professor Bach, but this time around, one cannot afford to miss that bus. So you have to be prepared in terms of practices in business which can actually take care of that opportunity. And fortunately, the government is quite well aware of that this time around. The businesses are quite well prepared for it. And hopefully that we will be able to take advantage of some of the sectors in which businesses will come India's way, and they should be capitalized on. Similarly, for manufacturing, the PLI scheme has worked fairly well. It's a mixed bag, of course, but I think we've got to make it work better and make more use of the opportunities that the PLI scheme provides. Also, in terms of business practices, I think supply chain resilience is very important. So Indian companies should also go out and look at Southeast Asia in the immediate vicinity, for instance, for investments and for resources. We've got to look at Africa, which has been a market which has been ignored in the past. And of course, our traditional partners in the United States and Europe, and that trade needs to be strengthened. India is currently engaged in a number of new foreign trade agreements and negotiations, and these should be pursued quite seriously as far as possible, but also in terms of sustainability at home, in terms of new business practices which will then overcome what is coming around the world, for instance, the CBAM in Europe and also the Inflation Act in the United States, and also the fact that most countries are taking some protectionist measures. So all that needs to be taken into account when businesses try to plan what they're going forward. Thank you very much.
Thank you, Ambassador Wadhwa. I'd like to turn to Shiv Siddharth Kaul, our last speaker on the panel today. You can look at the geopolitics from the point of view of of a significant economic actor, and how that in your view impacts economy or growth in this country.
So I think personally the turmoil is a great opportunity for where India is right now. If you start with where we started, and it's been a running theme, populism is emerging everywhere, this trend of retaking back your manufacturing base, that's okay for India because where our strength, our comparative advantage lies is in services. And this nearshoring language that we're hearing is primarily in manufacturing. So as long as we keep doing our services well and we keep executing and we keep finding ways to maintain leadership, I think we will continue to do well. Our service sector exports are now 6% of global service sector exports. We're all very happy about that. By the way, that figure is the same as China. So we're at par with China in that. Whereas if you look at merchandise exports, China is 30% and India is 3% of the global export chain. So, services we need to really accelerate and try and get. So I like to think of service sector exports. If China is at 30% in manufacturing, can we get to that level in service sector exports? And I think the language of tariffs is a little more difficult to apply to that sector. Where we are vulnerable perhaps is in things like data localization, data protection. So that is the space where our diplomacy needs to operate to ensure that we have enough of diplomatic cover, diplomatic protection from that onslaught. The other thing that I personally don't think conflicts are likely to reduce. And so where we need Atmanirbhar is in manufacturing, because we need to ensure that our own manufacturing supply chain, whether it's for defense or whether it's for our own production, is resilient. Our own supply chains need to be secure. If we can participate in global supply chains, that's a big bonus. But I think we need to act to ensure that we can manufacture competitively for our own massive demand. And I think that's happening. I think the language of make in India, as long as we can make competitively for our own citizens, our own security will be all right. The other big threat is in rising debt levels, and this is not just an India problem. India is probably better off, but globally, government debt is exceedingly growing fast, and what that means is there is going to be an inflation trend, perhaps globally, and that inflation could easily reach our shores. So how do we prevent that from happening? Are we doing that well? Are we not doing that well? And are we making sure that our own house is in tip-top shape before we kind of think of the globe in those areas?
Thank you very much, Mr. Kaul. I'm going to now open up to questions and comments from the audience. I have time for just a few. Janmay, and then first Janmay, and then the gentleman next to you. I'm sure there is a mic that should come around to you.
I have a speculative question, primarily for you, Professor Bach, because you're in Europe. At what point will Europe pivot away from the US to China? So here is what I want to build up on. One, the Ukraine will continue to be a crisis. The refugees will continue to be in Europe. And the fear of Russia will only increase if Trump and Putin, get onto good terms. Just now, German auto, Italian engineering, French luxury are suffering because the Chinese market is going away. And now Xi is being a less muscular in his foreign policy. If the US is very, very tough with China. And is tough with Europe. Europe can improve its defense budgets because it needs to for itself. But at what point will it pivot away from the US towards China?
Thank you, the gentleman next. I'm going to take a couple of questions at a time before I give it an opportunity.
This is a question, I mean, any of the panelists are competent, but
Sure.
Professor Bach, maybe you could take this. You mentioned three pillars on which global dominance is established. I'd venture to suggest one and seek your thing, which is critical resources. It was fossil fuels in the earlier days and will continue to be for some more time. Now I'm talking about critical materials. Not so much the origin, but the ability to process. That's what China controls, right? So that is also one more vector. And how can countries like India respond to that? And added to that was a comment that Mr. Kaul made. He spoke about very high levels of debt. Is there an opportunity for a country like India in such a scenario? Your comments, please. Any of you.
Yeah, I'll take one more if there is any before I turn to the panel. Is there another question or a comment? Great. I think we're. If I could, since we will be running out of time very soon, I'm going to make this an answer and closing remarks. So if I can go the other way, if that's okay with everybody. So there was a question that came to you. Would you like to take that, and would you like to respond to anything that any of the other panelists have said?
I think the question was on debt, and is there an opportunity for India? So I think absolutely, but India is also suffering from a lot of off-balance sheet debt. So India is also in a precarious state, especially if you factor in local government and state government debts into our overall picture. So I think we are in a good shape because we are growing. And the opportunity is to ensure that we continue to grow without increasing the percentage of debt-fueled growth. And that is both from a private balance sheet perspective as well as a public balance sheet perspective, whether it's at the union government or the state governments or indeed at local governments level. So that's essentially my response to that. We are growing at 7%, and if we can continue that without fueling it by debt, we'll be in a very good shape.
Thank you. Mr. Ivory, would you like to...
On the same point?
Yeah, well, if you could respond to the points that were raised, and maybe if you had anything that you would like to respond to from the other panelists.
Sure, very quickly to the points raised. In terms of debt, when the next crisis hits, every country will be printing money. That's a given. The lower your debt is when you start doing that, obviously it's healthy, but the ship SS Prudence is going to sink. And the only issue is, can you end up clinging to the person who has the largest piece of driftwood on the sea afterwards, which again will be the US dollar. So you'll still want to be closer to them, even in that negative scenario where everyone's printing money. In terms of resources, yes, and critical resource processing, that's also important. The US has every resource under the sun, but they just process them in China because it's cheaper and all the pollution is over there. They can bring that all home in 5 minutes. And in fact, just overnight, we've seen Donald Trump tweet, because policy comes by tweet now, that anyone investing more than $1 billion in the US will immediately have all environmental regulations ripped up and all permits given immediately. So I think we can see what's going to be happening there. I'll leave it on that front, but I think that absolutely underlines the point I'm making about, the gloves are off now in America. This is a different ball game.
Thank you. Ambassador Singh, would you like to take a question?
Yeah. Thanks, Indrani. So on Janmej's point, not to preempt what Professor Bach might say, so I don't think the Europeans will pivot towards China as such, because for a long time the Europeans didn't see China as a strategic threat. They saw China just as a trading opportunity. It was only under American pressure, and when the US started focusing more on the Indo-Pacific, that the Europeans realized that to keep US engaged in Europe, you must show interest in the Indo-Pacific. And then they started talking of the China's strategic challenge. So Europe came out with the Indo-Pacific strategy. Germany, Netherlands, UK, France, they all came out with Indo-Pacific strategies. And now because China is seen as strengthening Russia's defense industrial base, and also because China has reached Europe through ports and through the Arctic, that they see China as a strategic challenge. So what will happen is if they feel abandoned by the US in the context of the European security architecture, they will not go along with the US assessment of China on the strategic threat. But given the fact that they see themselves as democracies, their way of life, etc., they are not going to line up with China against the US. That would be my assessment. Now, in terms of the question on critical minerals, clearly there is a recognition of the challenge, and India has also joined the Mineral Security Partnership. And if you see the membership of the Mineral Security Partnership, it's US and Canada, 8 countries of Europe, ROK, Australia, New Zealand, and now India has joined. So that's not the usual kind of grouping that India joins, but the very fact that we are going there shows some of the strategic alignments or realignments that we see may be in our interest. And just 2 other points, Indrani. One, the other thing we have to prepare for is this time the Chinese have prepared themselves to impose counter-sanctions. They have sanctioned Micron, they have sanctioned NVIDIA, they have done export controls on 3 critical minerals. So that will be another dimension that will play out. Earlier they had sanctioned South Korea, Japan, Australia, Lithuania at different times. So that's one dimension. And the final thing that has happened is that we saw the European theater and the Indo-Pacific theater as 2 distinct theaters, including in geopolitical contestation. Today, the European, the West Asian, and the Indo-Pacific theater have become one theater. You have North Korean soldiers fighting in Russia against Ukraine. You see, because of what's happened in Russia-Ukraine conflict, Russia not been able to sustain the Syrian leadership, and that has collapsed. And clearly also there is a link between China and Russia, and therefore a certain focus on the Indo-Pacific theater as an outgrowth of whatever is happening in Europe. So all these theaters, the contestations are combined. So there is a major global contestation going on, and there will be consequences as we discuss, which we have to prepare ourselves for. Thank you.
Thank you. Anil, while when you are responding to the others as well, would you like to also touch upon the fact that in the geopolitical churn that we are witnessing around the world, there is a significant churn because of a geopolitical contestation between India and China as well, which has its own...
Yes, so certainly there is, a big effect that the China's rise has had on Asia, and particularly as far as India is concerned. I did mention in passing that the Chinese rise has meant more of a presence in around India, especially in the Indian Ocean and the southern Indian Ocean in particular. The rise of Chinese presence in countries around India, but we will see more of it going forward. And that's because there is a build-up which is happening as far as the Chinese Navy is concerned, also its nuclear forces, its missile defense, etc., etc. At some point in time, the Chinese will have to find an outlet for this in other parts of the world. And the closest proximity is, of course, the Indian region. We can also expect an increased Chinese presence in the Middle East, in the Gulf in particular, where there are already economic investments, and to protect those and also to make sure that their sea lanes of communication have alternate routes, the Chinese naval presence will grow. That's a given fact. We also have a situation on our border, which, as you know very well, recently there's been a disengagement process which has been started. It's not a situation which has gone back to 1920, which happened before Galwan, but we are in the process of trying to restore that status quo, which India hopes for, and the Chinese would hope that would not come to that pass and would try to look over it. But I think the constant endeavor would be to go back to that situation. And meanwhile, if you see the economic situation which exists between India and China, there's a huge trade deficit, as we all know. In some cases, it's not bad that there is, there is an investment into India from even a country like China, which is needed. So I think the current effort is to see whether there is some amount of kind of guardrails which are imposed. There is also a caution, certain amount of caution for certain sectors, which will happen going forward. But I think that dependency is not going to go away very quickly. On the point about critical minerals, I think you're absolutely right, because there was a time when the Chinese went in very strategically for acquisition of critical minerals, but also invested in processing facilities back home. And if you look at lithium, for example, it's a very polluting industry to process it. So obviously countries do not want to do that if they can help it. And that's exactly what happened in countries like Australia, which are naturally endowed with lithium. But at the same time, there's a realization now that there should be some diversification. So there are more countries which are coming into play by way of processing. India is one of those countries that has the capability of doing so and will do so in the future. And the same goes for, if you look at chips and in computer software, hardware, both. Because anything to do with future technologies is something which needs to be developed and adapted in India as well.
Thank you. Professor Bach, I think questions were addressed to you.
Yeah, but they've been answered so effectively by my co-panelists. So on the question of Europe pivoting away from the US into its China, I completely agree with Ambassador Singh. If you look at the history of the transatlantic relationship after World War II, you see at various moments efforts by Europe, usually led by the French, I should say, to carve out a distinctive position internationally. And quite interestingly, it was President Macron of France just last year who said Europe should not get dragged into the conflict, the rivalry between the US and China. But of course, as long as Europe remains dependent on the United States for security, there's only so far that Europe can go. One of my colleagues recently remarked, I thought quite cleverly, that when it comes to Germany, Germany outsourced its security to America, it outsourced its energy to Russia, and it's outsourced its growth to China. And to some extent, that represents how Europe has been operating. Now, as a result of Russia's invasion of Ukraine, Europe has fairly quickly weaned itself off of Russian energy at considerable economic cost, I should say. I think it's more likely to wean itself on dependence on growth from China than on American security. So everything you say would depend on an independent European defense capability, and I just don't think that that's on the horizon. And even if it were, you still have the ideological links between the US and Europe, despite all of their differences that would stand in the way. I will say, however, that what I'm quite excited about is opportunities for Europe and India to intensify their collaboration, not just economically, but politically, because one thing is to be broadly allied with the United States, but another one is to pursue within that context strategic interests. And I think India and Europe have a whole lot of interests in common, again, economically and politically. I'll make just one last quick point on critical resources. I said before, my premise was that this current geopolitical context provides opportunities for countries to benefit from the rivalry between the US and China. And we talked about India, of course. We haven't talked about Africa. And Africa has been very much a subject of overtures, of course, first from China and more recently from the United States. And Africa is resource rich and rich in minerals. And I think there is a desire to make sure that the exploitation or the production, I should say, of resources this time around goes hand in hand with investments in processing and in manufacturing. I think there are a number of African leaders who are quite keen on making sure that African resources can lead to job formation and broad-based economic growth. And so again, there the question is going to be, what role are the various economic powerhouses going to play in helping Africa leverage its immense resource wealth into broad-based prosperity. So another place where I would look for additional sources of power and influence, as you rightly put it.
Thank you, Professor Bach. We are completely out of time, of course, but thank you very much to the panel for a great discussion, and as well as to the audience, and very good afternoon to everyone.
Thank you, Ms. Bagchi. May I request you to kindly hand over a token of appreciation to all our panelists, please. And I will request Mr. Siddhant Kaul to kindly hand over a token from our side to Ms. Bagchi for moderating the session beautifully. May I request all the panelists to step forward for a photo op, please? Our next session, ladies and gentlemen, will be here in this hall, and we will start. The session is on emerging out of the post-COVID world, monetary policy and fiscal policy actions. This session will happen here in this hall, and we will start as soon as we've turned the table around. I request all of you for your patience and to remain seated. Ladies and gentlemen, request all of you to please carry your cups of coffee or tea and bring it back to the table. We will be starting with the session right away. May I request our panelists to be brought onto the stage, please. For this session, we have with us Dr. Francisca Onsoj, Chief Economist, South Asia Region, the World Bank Group, USA. Dr. Philips Carlson Zak, Global Chief Economist and Managing Director and Partner, BCG, USA. Dr. Ronald Salgado, IMF Senior Resident Representative for India, Bhutan, IMF. Dr. Ashima Goel, Emeritus Professor, Indira Gandhi Institute of Development Research and former member of the Monetary Policy Committee of RBI. We have all of them on stage, ladies and gentlemen. I'd like to invite Dr. V. Anantha Nageshwaran, Chief Economic Advisor to the Government of India, to give his opening remarks and chair the session. Over to you, sir.
Okay. Good afternoon, ladies and gentlemen. Thank you very much for being here. I know that sort of towards the fag end of a long day, too much of intellectualism, and therefore you might be looking for some caffeine shots. I hope you can pick up your coffees and teas and come and settle down here. So what we are going to be dealing with in this session is in the post-COVID world, which we're already 4 years into it, the kind of monetary and fiscal policy world that we are entering into. Generally speaking, in the last 35 years, since 1980s, maybe until about 2016 or even 2020, was the era of globalization, steady expansion in global trade, movement of goods, services, and even of people, in some cases of jobs. And that happened to coincide with, or was also an important component of it, was the monetary policy autonomy, monetary policy independence, focus on inflation targeting, liberalized capital flows, and basically it also saw the rise of central bankers as very important policy players. And in fact, the role of governments in terms of fiscal policy was just to make sure that the fiscal policy was generally prudent, keep deficits low, don't overextend yourself, and don't become a pain in some part of the anatomy for monetary policy makers. That was the only role given to elected policy makers. So much so that, the Committee to Save the World was the cover in the year 2000, featured a central banker on the cover, along with the Treasury Secretary, and I forget the third person who was there in that Time magazine cover in the year 2000. Of course, shortly after that, the stock markets imploded. That's a different story. So, in general, that was the era. So now that this order, this world order, which you heard in the previous session is also, that world order is changing. Whether or not globalization is going to full-scale reversal, we know that it is not going to grow at the same pace at the minimum. If anything, it may go into reverse, and if it goes into reverse, at what speed will it go into is something that we can debate. But along with that, therefore, the primacy and the eminence that monetary policy enjoyed in the last 30 to 40 years, will that also change? Because when it comes to inflation targeting and the success of it, the truth is, post-2008 financial crisis, central bankers tried their very best to reignite inflation with zero interest rates and quantitative easing. They didn't really succeed. And Japan's monetary policy, for example, was a spectacular failure in terms of reigniting inflation, despite decades of zero interest rates and quantitative easing. Then what happened? Post-2020, suddenly when they didn't want inflation to rise, inflation went to double digits in many countries in Europe and even in the United States, post-2020. And that's partly not because monetary policy succeeded, but fiscal policy also stimulated the economy post-COVID. The economy was dislocated due to supply disruptions, and the combination of all these three factors, and the war in Ukraine and the energy prices going up, all these things contributed to reigniting inflation. And we realized, therefore, inflation was not really a monetary phenomena. It required other people to participate to create inflation. More than that. And if anything, therefore, the secular disinflation of the 1990s might very well have been a stroke of luck for central bankers due to confluence of global trade integration, low energy prices, low commodity prices, but they enjoyed the reputation of inflation slayers. So are all these things going to change now? In spite of the fiscal policy makers being told to remain generally prudent, the truth is in developed world, public debt has now assumed very large proportions. To the extent that, therefore, interest payments in the United States, for example, now exceed the money spent on defense. Therefore, will central bankers be inevitably dragged into allowing fiscal policy to dominate monetary policy? In other words, whether we like it or not, will financial repression become necessary in the developed world to bring down the real value of debt, as it happened between 1950s and 60s into 70s? The post-World War II debt ratios were brought down in this manner. The second question I want to leave for my panelists is, while there was so much concern in elite circles about not allowing monetary policy to be fiscally dominated, in the process, was monetary policy allowed to be financially dominated by the concerns of asset prices and the financial intermediaries, capital market intermediaries, to be more precise, in the last 30 to 40 years? Will that also undergo a change? For example, notwithstanding the rise in interest rates in the US from 0 to 5.5% between 2022 and 2023, Chicago Fed National Financial Conditions Index remained pretty much in expansionary territory, in loose territory, in the last 2 years or so. So therefore, will financial dominance have to give way to fiscal dominance necessarily? Will that be good or bad? And if real value of debt has to be brought down, then what does it do to inflation targeting regimes that we have had so far? Even though it has had accidental success and relatively prominent failures in the last 3 decades. These are my questions for my speakers. Each of them have about 8 minutes or so. Some of them will make standalone remarks. Some of them will make a presentation. I'm going to call them out in the order. You have the speaker bios in front of you, so I'm not going to take up much time reading the speaker bios. We have Dr. Anil Salgado, IMF Senior Resident Representative for India and Bhutan at the International Monetary Fund. He will go first. Second, we have Dr. Francisca Onsorge, Chief Economist for South Asia in the World Bank Group. We have Dr. Philip Carlson Slack, Global Chief Economist, Boston Consulting Group. My apologies if I didn't pronounce his last name correctly. Dr. Ashima Goyal, Emeritus Professor, Indira Gandhi Institute of Development Research, and former member of the Monetary Policy Committee. We have a very distinguished panel with us. So I'll first invite Dr. Anil Salgado to share his thoughts on the questions and the issues that I posed in my initial remarks. Over to you, Anil.
Thanks, Ananta. You posed some very good questions, a little broader than I will talk about in my opening remarks, though I will try to hit on at least a couple of them. So my remarks are more focused on developments and policies in the Asia-Pacific region over the past 4 years or so, since we had the COVID-related shocks. And focused, of course, on monetary and fiscal policy. So first, let me start with monetary policy and inflation. So we had this surge in inflation in the recovery from COVID, both in terms of intensity and persistence. It started in 2021 and parts of 2022. But you have to remember, a lot was going on at that time. We had very accommodative monetary and fiscal policies after the COVID shocks. We had supply constraints and surges in energy and food prices, at least partly reflecting what was happening in Europe with Russia's invasion of Ukraine. Ananta mentioned Japan. I was mission chief on Japan for the IMF until May. And even in Japan, we saw inflation rising to close to 4% and staying above target for over 2 years. And that was from close to 0 to less than 1% inflation for the previous decades. However, in the region as a whole, inflation outcomes have been lower than what we found in other regions. And we also have to acknowledge that the variation was quite wide in the region. And what was interesting is inflation tended to be higher in advanced economies than emerging markets. So how do we explain all this? Well, 2 sets of shocks were important. First, there were some external cost push shocks, especially food prices, which impacted inflation overall. the impact of food price pressures was generally lower in Asian emerging markets than in other regions, despite relatively high weights on food inflation, headline CPI. And this partly reflected other compositional effects, as well as policy measures, such as subsidies and price controls. The pandemic itself had complex effects. Lockdown set off demand and supply shocks. The supply shocks constrained production, while border closures generated shortages in migrant labor in some of the countries in the region. But overall, demand effects dominated. The lockdowns were generally longer lasting for Asia than elsewhere, and that had some dampening impact on inflation. So how did monetary policy react? So globally, we had this period of quite synchronized monetary policy tightening. And actually, one of the first movers was in the region. It was Korea in August 2021, and also Singapore and New Zealand soon after began to tighten monetary policy. So with falling food and energy prices and restrictive monetary stances, headline inflation in the region generally peaked and started falling towards the end of 2022. That said, financial conditions in advanced countries, except for Japan, have tightened, as we saw elsewhere. However, in emerging markets, financial conditions remain relatively accommodative. So this meant overall that monetary policy in the Asia-Pacific region, you couldn't follow necessarily a one-size-fits-all model. And the priority of central banks was to ensure that inflation converged to target. At that time, we urged central banks to focus firmly on domestic conditions, avoiding making decisions overly dependent on what was happening with US monetary policy, which could lead to inflation falling behind or ahead of the curve, and could destabilize inflation expectations. So where are we now? Disinflation has progressed across the region, and most central banks have started to shift to a more accommodative stance. Stepping back, what was observed globally was a quick rise and fall of inflation. The question is, what explains this behavior? On one hand, you could argue that inflation rose because they were subject to varying degrees to a similar sequence of shocks: the pandemic, then mobility restrictions, and then large policy support. On the other hand, one could argue inflation rose everywhere because of global causes, such as higher energy and food prices. Recent research at the IMF showed that the inflation rate patterns, trends, were primarily linked to global drivers, but local circumstances also mattered. For example, differences in local energy prices, including subsidies for people, price policies, including subsidies for people and businesses, explain differences in the role of energy price shocks in driving inflation. And I think this is true for a number of emerging markets. And monetary policy also played a critical role in defeating inflation. In terms of fiscal policy, the focus at the start of the pandemic was to save lives and livelihoods. So even we at the IMF advised countries to spend heavily, significantly, and they did, swiftly and forcefully. If you add up the total, it was a staggering $12 trillion globally in terms of fiscal stimulus. In the Asia-Pacific region, it acted countercyclically, especially in the advanced country and emerging markets. We found it less so to be true for some of the lower income countries. Also, we saw coordination of fiscal and monetary policies, with 95% of the countries in the region adopting a looser policy mix during the crisis. However, the fiscal costs have been large, and the IMF has written about this, with debt levels much higher. For example, for advanced countries, debt has increased by 14 percentage points of GDP, while in emerging markets, 16% of GDP since 2020. Moving on to the exit from these policies, The exit has not always been smooth. For example, fiscal policies were not reversed fast enough, and this led to pro-cyclical policies. As inflation soared as well, governments faced trade-offs in tackling spikes in food and energy prices when policy buffers were largely exhausted. And some countries used fiscal tools to control inflation, such as subsidies and price controls. An example is fuel subsidies increased substantially for many countries in the region. Monetary and fiscal policy support was paramount, including tightening financial conditions, and elevated debt, which Ananta, I'm running out of time here. Maybe I'll stop there and add the comments later.
Sure, thank you, Ronald. Just one quick question. You may not want to answer it right now. You can probably respond after other speakers have finished speaking. Therefore, the question is, are you basically saying nothing is broken? Is that yeah, you may want to answer now. You can respond later.
Maybe I'll respond.
Later. Okay, so now I turn the floor over to Francisca. You have your 8 minutes now.
I'll go to the podium because I can't handle 3 things. So for us, the last 5 years gave some wonderful examples of old lessons applied and new lessons learned. So let me go through them a little bit if the presentation comes out here. In 2019, we were worried that the global economy might be an accident waiting to happen. Global debt, at least advanced economy debt, was at record highs, the highest level since the 70s, and even in half of emerging markets, debt was at record highs, the highest on record. At the same time, potential growth had been slowing for a decade already. So potential growth is this long-term sustainable growth. There we go. And when do accidents happen in the global economy? When do financial crises happen? Well, they happen under 3 conditions. When you have high debt, when growth slows a lot, and when US federal funds rates, so US policy rates, peak. And then the pandemic struck. I mean, talk about low growth. Yeah. So you see in the chart on the left what the pandemic recession did. In the chart on the left, you have what happened to per capita GDP growth, per capita GDP, in each of the last global recessions. 2020 was the deepest output contraction since the Second World War. And yet the global financial system just shrunk. There was no major economy that had a new crisis. There was still some old crisis being worked through. So that's in the chart on the right here, the red line for you also on the right. Although several of the smaller countries did tip into a crisis, and that includes some of India's neighbors. In advanced economies, output was back to pre-pandemic, not just level, trend. That's the chart in the center here, the red line, already within 2 years. Compare that with 2009, when even 5 years later, the blue line in the center, it was still below the pre-global financial crisis trend. And the reason the impact was relatively short-lived in advanced economies is the lesson they had learned from the global financial crisis, that front-loaded large fiscal and monetary stimulus can prevent lasting output losses. So basically, they thought this stimulus is what brings us from the blue line to the red line, yeah? Prevents the blue line happening again during the pandemic. And the stimulus was large. On the left side here, you have fiscal stimulus. On the right side, you have monetary stimulus. In advanced economies, the stimulus was large. So for example, the left chart shows you the cumulative fiscal stimulus in red after the global financial, in solid lines after the global financial crisis. No, in solid lines during the pandemic, in dotted lines after the global financial crisis. For advanced economies in blue and for emerging markets in red. You can see that both in advanced economies and in emerging markets, fiscal stimulus was about a percentage point of GDP bigger than in the pandemic than after the global financial crisis. This was a lesson learned from the global financial crisis and applied during the pandemic. Another lesson was on monetary policy. After the global financial crisis, here in the chart on the right, you see monetary policy rates. Monetary policy kind of at least in advanced economies, but also in emerging markets and developing economies, took a while for interest rates really to be, policy rates to really be cut aggressively. And then gradually they were cut. After the pandemic, they were cut within 2 months to zero. And then they stayed at zero. Policy rates in advanced economies, the blue line here, the blue solid line on the right, stayed at zero for almost 2 years. And that, of course, meant that real policy rates were very low for almost 2 years. Now, emerging markets applied a similar lesson on the fiscal front, but not quite the same lesson on the monetary policy front. So emerging markets and developing economies, here the red lines in the left chart, also provide about a percentage point more stimulus than during the global financial crisis. But on monetary policy, they were much more cautious. Yes, they cut their policy rates, but much less than they did during the global financial crisis. And also they started raising rates, policy rates, already 9 months in. I think Ranil mentioned that. They started policy rates already 9 months into the pandemic because they were worried about inflation pressures. And then this was a lesson learned and applied. Now we come to the new lesson learned during the pandemic. So this extremely accommodative monetary policy globally, of course, then led to very high inflation. And it was kind of a handover from the pandemic supply shocks. We all remember those ships being stuck in harbor. A handover from these pandemic supply shocks then to demand pressures, and then compounded by a commodity price shock after Russia's invasion of Ukraine. And global inflation, you see that here in the left chart, that rose to the highest level since the mid-2000s. Advanced economy inflation actually rose all the way back to 1983 levels. Maybe some of you remember the famous Volcker recession that was caused by an attempt to rein in that advanced economy inflation. And even in emerging markets, and that's the point of the chart in the middle. Remember, emerging markets started tightening policy rates already 9 months into a pandemic, about a year before advanced economies, and still inflation edged up. That's the red line, the red solid line in the center chart here. Still inflation edged up. So that was one of the lessons, the new lessons for emerging markets. And also something that Ananta mentioned. It's hard, it's really hard. It's really hard. Actually, it's something the finance minister this morning mentioned. It's really hard for an emerging market central bank by itself to control its own inflation when around it, everywhere else in the world, inflation is going up. So these inflation spillovers, that is one lesson that emerging markets learned. Advanced economies perhaps learned another lesson, or relearned an old lesson. An extreme amount of monetary accommodation held over a long time, if there's enough shocks will lead to inflation pressures, even in a country that has very well anchored inflation expectations. And then, of course, as soon as that became inevitable, central banks started raising interest rates. You see here in the chart on the right the G7 policy rates. G7 monetary policy rates since the pandemic, since 2022, rose at the steepest and fastest pace since the 1970s. Remember those rates that had triggered the famous Volcker recession in the early 80s. And of course, that then did help bring down inflation, but other things also helped bring down inflation. That's perhaps another lesson, the legacy of good old policies. The global trade system was so flexible that it managed to dissipate these commodity price shocks within 6 to 8 months, 6 to 9 months. So that was one thing that helped. Another thing that helped was decades of building inflation credibility by advanced economies and emerging markets as well. And then also in many countries like India, what helped was the building of, making debt more resilient, maybe more domestically financed. Now the big question will be what the next lesson will be. And perhaps that will not be about how to manage crises, because we've had lots of practice. Maybe that will be how to build growth, sustain growth, which is weighed down, which may be weighed down by industrial policy and trade restrictions. Thank you.
Thank you, Francisca. The screens here have gone blank. Okay, so we have Dr. Philip Carlson to speak next, and I'm just told that in July he published a book with the title "Shocks, Crisis, and False Alarms." And in a pre-session meeting, he told us that the central message of this book is that economics is broken, economic forecasting is broken. And therefore, he is the right person, therefore, to address the question of this session. So over to you, Dr. Philip Carlson.
Thank you very much. And I don't know if we can bring the slides back up in front of us. Well, and at least you see it on that side. I think that side is blank, but that's good. Let me first say, when we talk about fiscal and monetary policy, what we generally mean is stimulus, the ability to backstop economies when on the brink of crisis, or to accelerate and slow down economies during the cycle. And in my role, I speak with many, many boardrooms in America and globally, as well as institutional investors, and the question that comes up very often is stimulus at risk? Will we be able or not to backstop the next crisis, and will we be able to juice the economy when we need it and slow it down when not? Now, just as a baselining exercise, the false alarms of the last few years, they're all connected to a misreading of stimulus. Remember the COVID depression? That wasn't. That was because there was a misreading of the amount, the innovation, the willingness and ability of stimulus. It was a fast recovery instead. Similarly, the idea that we're returning to a 1970-style inflation regime was also connected to a misreading of stimulus, which ascribed it only to fiscal policy, which was misguided. Then when we removed stimulus in 22, 23, it was about a supposed cascade of emerging market defaults, which also did not happen. And in the advanced economies, it was about an inevitable recession, the idea that higher interest rates would inevitably lead to a downturn. Now, clearly public discourse, punditry has gotten stimulus wrong repeatedly over the last many years. On the right-hand side, you see the problem with economic forecasting. The dashed lines are economists' consensus. Every single quarter, GDP was forecast as negative, recessionary for the US, and every single quarter it wasn't. And then this pessimism was simply punted out on the timeline, highlighting the inability to actually forecast this with any degree of precision that would be satisfactory. Now, let me talk a little bit about what I think we need to do to get a better handle on stimulus and its success or failure. And that requires a more eclectic approach, thinking not just about forecast models, but really about history, finance, policy culture, and things like that. And here, in my recently published book, I call this the compulsive stimulus machine, really a 50-year story of how stimulus has evolved in the United States and other countries around the world. Yes, growth in the first panel, it slows down over time. That's sort of a natural course of growing richer and a wealthier economy. And that leads to a political economy pushback, ever more stimulus. So in the 80s in the US, under Reagan, we started with debt. And then leaning against that slowdown over the decades, we became tolerant of bubbles. First of the dot-com bubble, which pushed consumption, which pushed growth. When it collapsed, we moved to a housing bubble where homes became cash machines. When the housing bubble popped, we moved to a bubble in the term premium where long-dated government bonds became bubbly and underpinned a lot of asset classes and their prices. I haven't even mentioned the Fed put, I'll come back to that, and the deficits, but between all these tools, there's a seamless wall of stimulus that reigns the economy. Now the question is fair. Is it overdone? Have we pushed too hard? Can we do more in the future? Now let me go into existential stimulus first and then tactical stimulus. Look, I view US existential stimulus capacity as exceptionally strong, despite everything. And not just the US, I think most advanced economies will have the ability to tap into financial markets to finance the next round of stimulus if there is a big crisis. On the left, a reminder that yields fell around the world, not just in the United States when COVID hit. And that really speaks to the enhanced willingness and ability in times of crisis to mobilize resources. That is not just a US thing, but particularly a US thing. Yes, you can land in stimulus failure. History has shown that. It's when policymakers fail to act. That's the 1930s Great Depression. Policymakers standing by, letting the economy bleed out. They're less likely to do that today. Yes, when politicians fail to act, that was TARP in 2008, when US Congress failed to pass a $700 billion stimulus package. but then did do that because it saw the consequences, or when you have market rejection of funding, which I think is a very, very high bar for the US and most advanced economies. But let's double click on that last point. Is US debt too high? Is there too much debt out there to be comfortable about the future of stimulus? Now, essentially, I view the focus on debt levels as deeply misguided. What we see in the headlines day in, day out is the trillions of dollars of debt or the debt to GDP ratio. Yes, they're very high. Does it tell us a lot about debt and debt risk? It tells us surprisingly little about risk. Why? Because the level of debt is not a good proxy. The question is the sustainability of that debt. And that comes down to what's on the right-hand side here. Nominal growth versus nominal interest rates. When nominal growth is higher than nominal interest rates, we can carry whatever mountain of debt before us without having to set aside real resources. So the question comes down, over the long run, do we believe that US nominal growth is going to be higher than nominal interest rates? Generally, I think so, yes. What you see on the right-hand side conceptually is the diagonal line where they're roughly in equilibrium. If you look at 100 years of R versus G in the US, you see the red dots that populate this picture now. We've been all over this map. But mostly we've been above this line, particularly in the 2010s with lots of financial repression. But even when you're on the line or just below the line, it doesn't mean game over. It just means it becomes harder in terms of trade-offs we need to make. So existential stimulus, in my mind, is in a good spot. What about tactical stimulus? And I think here is where we really have seen a change come out of COVID. So in the 2010s and before, we had grown accustomed to the Fed put. When there was any worry about the economy, when markets sold off, you immediately had a monetary policy response. In this picture on the y-axis, when the equity market sells off, you immediately see the 2-year yield going to the left, coming down. Why? In anticipation of a Fed put. And that was really the Fed consistently defending the cycle at any sign of worry, really creating a moral hazard problem in financial markets. Now, what you can see in the darker green dots on the right-hand side, in 22, the Fed was not able to defend the cycle. It had to defend the inflation regime. And this is really rates rose even as equity prices came down. And I think this is a lasting consequence, even as inflation has come down. That will stay with us. We're now constrained with tactical stimulus cyclically because essentially of this and my last picture. Yes, inflation is down a lot. So the 1970s narrative was entirely misguided. But note that in the past, to the left, we struggled with the 2% inflation target. Now we're likely to stay above it. So even though inflation isn't very high, the mere fact that it's biased to the upside will constrain monetary policy response. And if they want to do a Fed put, that is now a lot harder thing to do. On the right-hand side, a reminder, the neutral rate of interest at around 3%, who knows exactly where, but let's assume it's around 3%. We're not going below neutral. We're going to stay above neutral. And all of these things will constrain tactical stimulus. With that, I only have one thing left to say. Allow me a quick plug. This and other themes from my recently published book, Shocks, Crises, and False Alarms. Thank you very much.
So we have Dr. Philip Carlson saying basically there is nothing to worry and you can party as hard as you want. Is that the message, Dr. Philip Carlson?
Not on the tactical side. Okay. Tactical side is constrained
structurally. So then we have to have a separate session on tactical, the duration of the tactical horizon and the strategic horizon. Okay, that will be a separate session. We will tell CIA to do that later. But now I have the last but not the least at all, Professor Dr. Ashima Goel. She was a member of the Monetary Policy Committee of the Reserve Bank of India. She's a prolific public commentator and professor emeritus at the Indira Gandhi Institute for Development Research. Over to you.
Thank you. And thank you, CII, for the invitation, for bringing so many people together on these important global topics. So I'm going to talk about the emerging market perspective. And basically, as we've all heard, there was a huge fiscal stimulus, basically an overreaction which continues in advanced economies. And this has resulted in monetary policy tightening. Rates remain higher than they were earlier. But it has worked in the sense inflation has come down. The US is scheduled for a soft landing. But there is a cost, which is higher inflation, higher interest rates, higher public debt. And this higher public debt will result in higher interest rates, also volatility in US security yields, which are the safe yields for the world's capital. And emerging markets sees volatility, capital flow surges coming in and out whenever these rates change. So India has faced all this, and the main point I want to make is that for the first time, I think we had the buffers to do it, and we decided to smooth these external shocks. And we use structure strategically to do this, and this has given us one of the highest rates of growth in the world in the post-pandemic years, and inflation that stayed within the tolerance band. And maybe since this is for the global south, there are lessons to learn in this slight differentiation of monetary policy which is possible for emerging markets and can help them. And this answers the question Anand posed for us, that policy is not broken if you do it well. And there is room in many emerging markets to do it well. Yeah. So there is this recovery, but the stimulus in emerging markets was much lower than in advanced economies. And this will result perhaps in volatility in treasury yields going forward. There's no sign of fiscal stimulus, another being reduced. Deficits continue to be at 5 to 7% of GDP for the US. And here also there's a lesson from India in the sense that we are one of the very few countries which is reducing debt and central deficits, with stimulus continuing basically from better quality of spending. So these are the kind of shocks we've had to deal with. This is a picture of oil price shocks. And the other issue is that emerging markets today account for a larger share of global growth, and therefore what the spillovers that affect them create feedback for advanced economies. So there is room for policies that reduce shocks to emerging markets also. So how did India smooth shocks? We've had high average growth rate, about 6% since the liberalizing reforms in the 90s, but this growth was volatile. And so the change in the post-pandemic period was a stable growth for 3 years, about 8%, and there was financial stability as well as falling inflation. So how did this work? First of all, monetary and fiscal policy were counter-cyclical, and one indicator of this was that the real repo rate stayed low, and the real exchange rate also. Normally, in emerging markets, you tend to have very high growths, that nominal growth rate minus the real interest rate, but is high, but it's volatile because policy can't smooth shocks, so there's a lot of fluctuation. This is what happened to India in the last decade. This time we smoothly had R much below G, and this, in a sense, is a kind of it helps enforce this, because this is a positive feedback for the government, since the debt ratios and deficit ratios fall if R is less than G. So we can see this in interest rates that stayed low in the recent period, around 1% real interest rates, and this is a forward-looking real interest rate with the one-year treasury bill. For the other issue was that fiscal policy was conservative. After the global financial crisis, there was a jump up in all the deficit ratios, which inched down very, very slowly. This time it was more like a peak, partly because GDP fell so strongly, but after that, all the ratios have been decreasing. So this is also an example of monetary fiscal coordination, and sometimes, because the structure of the economy is such, we saw that the dominant shocks are supply shocks, oil and also food. So in this, fiscal policy can be more effective. And since fiscal policy was working on the supply side, monetary policy could afford to keep real rates somewhat lower. And this was also, as I said, credible. It was, the rewards to the fisc from higher growth helped enforce it. Another enforcement mechanism is that because we had an inflation targeting regime, so the rates, nominal rates were conditional on inflation. If inflation was going to be persistent and above our bands, then we would raise rates. And this was enough for monetary policy to be credible. Rates did not have to be high, they only had to respond to persistent inflation. So this is also a sort of enforcement mechanism since policy was conditional on inflation. So we see this, that in WPI inflation, the dotted blue line was really high and volatile in this period, but headline inflation, which is the target, stayed pretty smooth. The fluctuation, the volatility was much lower than in earlier periods. And the other issue is that in emerging markets, the sort of shocks we see with the capital flows tend to increase risk premiums. The interest rate spreads are much higher. And one major contributor to this is the exchange rate volatility. The research shows that the uncovered interest premium is about 3%, which is much higher than actual depreciation. So the other was using multiple instruments, such as the large buffers we had built up, as well as sequenced capital account convertibility, to reduce the volatility of the exchange rate, even while it remained market determined. So this reduced interest rate spreads the risk premium. Also, macroprudential regulation in the financial markets. We heard this morning about strong bank balance sheets, etc. All this reduced risk premium also in financial markets helped interest rates fall through the spectrum. So in sum, we would say that it is possible to adapt policy to structure and to the kind of shocks you face as an emerging market. And we've just seen these kind of shocks apply, as well as capital flow surges, risk premium in financial market. So, but very important, while inflation targeting worked, flexibility was very, very important, and balance. Time's up, so I won't go into details, but there are lessons there for how we need to be more nuanced in the way we analyze monetary policies, fiscal policies, and the kind of standards we hold up to emerging markets. Thank you.
I guess one could see that despite being out of the Monetary Policy Committee, Dr. Ashima Goyal held her horses back in the last slide. But anyway, we will continue. We will take up some questions with you. Now that all the four speakers have made their initial remarks, I'll just go back to just posing one question each to all of them and then open the floor for the audience to participate. Otherwise, this will become a typical central bankers kind of meeting, talking among ourselves and the public just being a passive spectator. So we don't want to emulate that. We would make it more participatory. So we will first start with Ranil. So Ranil, basically, is nothing broken and nothing needs to be fixed in the monetary fiscal policy framework, either in the developed world or in emerging markets?
Right. So I'm going to lean towards there are things that don't need to be fixed, but I will then address some things that will need to be fixed. So first of all, if you think back to 2021, and inflation was rising in the US, maybe they were looking back at what happened in the global financial crisis. So they were taking their time before they really ramped up monetary policy. But if you thought that the Fed would raise 75 basis points in 3 consecutive meetings, the concern, at least in Washington, was this would lead to massive crises around the world, massive capital outflows from emerging market economies, and eventually lead to a significant recession in the United States, right, in order to control inflation. What happened? No crises in emerging markets, and the US so far seems to be able to, the Fed has been kind of navigating maybe a potential soft landing. We have to yet see. We don't know if it's a no landing, soft landing, or hard landing, but so far it's been guided. Philip showed the forecast errors. The forecast errors were people were expecting US economy to crash or go into recession much earlier. So something went right. And I attribute that, in emerging markets at least, to improved institutional frameworks. Ashima pointed that out, including in India with flexible inflation targeting, and the fact that emerging markets had already built substantial fiscal and external buffers. That prevented capital outflows. Now, we don't have the full answer yet on whether the Fed has navigated a soft landing, but if it has, it's likely because monetary policy in the United States effectively anchored medium to long-term inflation expectations. Yes, short-term inflation expectations rose along with inflation, but medium to long-term inflation expectations may remain relatively controlled. Now, there were other things going on in the United States as well, right? The United States opened up, including the immigration, that could have helped contain inflation as well as kept growth going. That's not to say everything was perfect. I kind of hinted already that maybe central banks were thinking about the global financial crisis and not taking into account how to think about COVID, which was substantial supply constraints in the context of significant macroeconomic stimulus, both fiscal and monetary. So central banks need to think about how to address a situation like that going forward. Then where things are not as clear that they're not broken, maybe on fiscal policies. So I always feel maybe the long lessons have been drawn from Japan. Because, back in about 2020, a lot of people were talking about this thing called, modern monetary theory, right? Where essentially you could, at least for at minimum advanced countries, but they were thinking even so for emerging markets, you could run endless fiscal stimulus, basically, because Japan ran endless fiscal stimulus. But that was in the context of, if you look at the macro balances in Japan, what you saw is after the collapse of essentially the financial or real estate bubble in the 1990s, first, you had a massive increase in private saving in Japan, right? So if you have a massive increase in private saving, the government was forced to offset that massive increase. So they had to dissave. Also, inflation expectations in Japan effectively fell to zero. So if you have an idea of having some positive inflation, it became very difficult for the Bank of Japan during the period to get inflation up towards a level that they wanted. So I think the long lesson was learned from that. It's not true globally today, especially with the growing demands for fiscal spending, whether it be for climate or for population aging, that you will have a continuing increase in private saving.
Thank you. So I think Ranal spoke like a true technocrat. He put the ball back in the court of the elected representatives to do fiscal policy better. So Francisca, so my question to you is, how do you see the central banks in the developed world react to, because Dr. Philip Carlson also said inflation could still be above the 2% levels. So do you see them resorting to financial repression? Will that become inevitable? Or they can continue with the business as usual?
Thank you for asking this, because we wrote a paper with Carmen Reinhardt on exactly how to resolve high debt, which most countries, the vast majority of countries has now record high debt. And one way of resolving it is financial repression. But financial repression needs to then be combined with capital flow controls, etc. It's not easy to sustain financial repression for sufficiently long to really bring down inflation. Really the best way to really bring down debt. The best way to bring down debt, and it's really a challenge that not just developed countries, that the whole world is facing now, even if Philip was saying we should dismiss it. But assuming we want to address the high debt levels, the best way is to do growth, to generate growth. And there I fear, and this links back to our monetary and fiscal policy discussion, fiscal monetary policy may well have reached their limits in achieving growth. So now it's a challenge for us. How can we generate growth without constantly resorting to fiscal monetary policy?
Okay. So you're basically not answering the question of whether financial repression will be necessary or not. Okay, I take the hint. I go to Dr. Philip Carlson. I think I'm going to take off from the remark made by Ranil about how US 75 basis point interest rate increases in 3 successive meetings was expected to bring the world down. It didn't. And part of the reason could be that the US fiscal policy remained quite expansionary throughout, even now it does. And secondly, if you look at the way energy costs have evolved pre-COVID and post-COVID, one of the few countries in the world where energy costs have remained relatively unchanged from pre-COVID levels is the United States. Compared to Europe, whether it is domestic users or industrial users, in Europe, the costs have gone up. And maybe the place where higher interest rates in combination with higher energy prices have brought economies down to their knees could be in Europe. So in that sense, what would be, you said, tactically the party can go on for some more time, and you said as long as R is below G, it's fine. But how do you see this monetary policy? You said, right, inflation could be tactically higher, and then this entire narrative around energy transition, raising energy costs for various countries. How do you square all this with your overall upbeat message?
Yeah, so let me maybe circle back to just a few things. So I didn't say debt isn't a problem. I didn't say it's desirable. I said if we want to predict crises, we need to be clear about the debt level as one problem versus growth versus interest rates, which is, I think, a much better guide to assessing risks from debt. In that sense, it really comes down to growth versus interest rates. And if you really want to argue that US nominal interest rates are going to consistently outstrip growth in the United States, then you should be very worried about the public debt level. I don't think it's a great proposition to take or a great argument to make, and therefore I stay pretty relaxed about sort of the big debt risks on US sovereign debt, just for context. Separately, the point about not seeing an emerging market crisis as a result of US monetary policy. I mean, this is one of the headlines I showed. It was such a dominant story. You're going to get a cascade of emerging market defaults. No such thing happened. I would say, echoing a little bit your point earlier, emerging markets got a lot better at doing this. So think about Brazil, think about Mexico. They came out ahead of the Fed. They raised earlier, they raised faster, simply staving off that kind of interest rate differential problem that you historically got. And sort of the memory of the late 1990s Asian financial crisis, I think, weighed on that and really improved monetary policy making. In keeping with one of my themes, let's not always talk down the economy, let's not talk down policy making. There's real progress, there's some real bright spots in how that was played over the last 2-3 years. On the energy side, I mean, for the US, it's one issue because essentially we're energy self-sufficient. It can even be an energy exporter, net exporter. So overall, I would think energy is also not as much of a story as it was 10, 20, 30 years ago. You know, the first Gulf War in 1990 put the US economy in a brief recession just because oil prices spiked. That is a much higher bar today. An oil price spike is not going to put the US economy easily into recession. I know that's a story that lingers out there in public discourse, but it's a very high bar for oil to push the US into recession. I will say the Eurozone too. I mean, following Ukraine, that was a universal prediction that not only would the Eurozone see a recession, but an industrial collapse and a deep depression, Germany most of all. Now, clearly they have a lot of headwinds. Germany is in a tough spot, structurally speaking, but there was no Eurozone recession. There wasn't one. right? There were pockets of weakness, but they were able to navigate a brutal energy shock way better than conventional wisdom had it, right? And so I think we need to just step back from extrapolating the data points. We need to have a lot of distance to public discourse. The financial headlines are already written to attract our clicks, our eyeballs. There's a business model behind it of monetizing ad revenue. So I don't think that following these cues from the headlines is a great way of looking at these risks. It's gone better than most predicted.
Okay, so it's gone better than most predicted. Dr. Ashima Goyal, the question to you is therefore, can emerging market central banks afford to sit back and follow their domestic economic imperatives, even if the Federal Reserve next year were not to loosen monetary policy as much as the financial markets are currently expecting? So have we really decoupled? That was one of the themes in the first decade of the millennium, but it was proved to be a false start. But this time, is it for real?
I think so. I think so, because we've had a lot of pressure after the Ukraine war when there were outflows and reserves were falling. Whenever reserves fall, even in the last 2 months, people get worried, let the rupee go, you lose. But we have enough reserves, and we find that inflows come back. So they are built up again. So we have the reserves, and moreover, because of sequenced capital account convertibility, we are not that interest sensitive. We are more growth sensitive, the inflows that we get. So we are effectively decoupled. But I think because a lot of the analysis and a lot of the inflows also come from the US, analysts are very focused on the US. But there is policy freedom, and I think we used it quite effectively these 3 years.
Okay, so if I'm going to probably do a mini summary before I throw the ball back at the audience court to ask their questions. So we have Ranil telling us that fiscal policy makers have to get their act together. Monetary policy makers are doing fine. And Francisca did not think that financial repression is really needed, but still debt is a challenge. Dr. Philip Carlson wants us not to take doomsday headlines too seriously. Things are going fine. And Dr. Ashima Goyal thinks that emerging markets have decoupled from developed country policies based on recent evidence. That, of course, begs the question of why Bitcoin is trading at 100,000, or for that matter, gold is heading towards $3,000, and why populations all around the world seem to be somewhat in an angrier mode, replacing governments and worrying about their future growth prospects. And Europe does give the impression of facing an existential political and/or economic crisis. So there seems to be some sort of a disconnect, if I may say so, from the headlines or the real news and the kind of sentiment that we observe around this podium. So with that sort of hanging statement from my side, I'm going to I'm going to invite audience to post their questions. The only thing is, it has to be a question as far as possible. If it is a comment, please don't make a speech. Just make a simple comment. Before I see some hands going up, I want to have some specific people ask their questions. I'm going to start with Mr. Tirthankar Patnaik to ask the first question. He's right here on the right side.
Sir,
please tell us whom you are addressing the question to. Yeah.
My question is to the panel, actually, and it segues from your comments, Dr. Van. I'm uncomfortable at the comfort shown in the panel, frankly. It seems like we've bested growth, inflation, we've bested crisis. We think, I think we know it all in some sense. But are we there yet? We have climate change. We have non-linearities coming up from climate change. We have an increasingly geopolitically active world. The last 30, 40 years were under cooperation that we can't see today. And we have also agents reacting far faster to policy earlier. We have this problem of sticky savings, slippery savings, which led to monetary policy not being so effective as needed earlier. And then we have the role of technology as well. So I'm Some comfort on this would be very helpful, sir.
So we will wait for a few more questions. I'm going to turn to this side of the hall, and I have Mr. Michael Every ask a question.
Hear me? Thank you. I don't know who I'm addressing this to, but it's 3 semi-technical questions that I hope would still be understood by the broader audience. Why is it that institutions are still sticking with neoclassical growth models which cannot forecast recessions, so therefore you can never see a crisis coming, when there are economic models out there that can, but you always refuse to use them? Equally, and more simply, why don't you incorporate GDP by supply, when you've had crisis after crisis after crisis recently, showing that what is supplied is as, if not more important, than what is demanded? So those 2 simple things, if they were addressed, could go a long way to helping these forecasts and these predictions and these policies make much more sense.
So I saw a hand going up there. Yeah.
It's an extension to discussion, in fact. Definitely there is something which we are missing out on. So, and what I understand, if to bridge between the monetary policy as well as the fiscal policy, maybe should we not include trade credit or the element of trade credit, which is not only about the borrowings, but also about the working capitals which are stuck and all of the issues around. For example, in underdeveloped countries or in developing nations, it is at a very high percentage. For example, in India, it is 80-90%. And also, the connected thing is, are developed nations also affected by this? And still then, why monetary policy is not having any element around this?
Okay, thank you. So I'll now I'll ask the panel to respond to these 3 questions / observations. So I would request Ranil to respond to the comment / observation, a question posed by Dr. Tirthankar Patnaik. Yeah.
Right. So I hope I didn't sound too complacent. I didn't mean to. I kind of said I'm going to be a little bit of a defender. Even for monetary policy, there are lessons to be learned, right? In some sense, monetary policy sometimes fights the last for too long. It has to be more forward-looking, right? So in the context of COVID, the analysis was based probably on the experience of the global financial crisis. And that was clearly not the way to go. So it needs to be a broader spectrum of analysis. So what we're growing focus is not just on the central bank's baseline forecast, but also the potential range of forecast and risks. So that's an example where monetary policy, I think, has to develop further, especially in advanced countries. That said, I still would be a defender broadly of monetary policy frameworks, especially the progress that has been made in terms of in many emerging markets.
So I would turn to Dr. Philip Carlson to respond to the points made by Mr. Michael Every.
I'd love to. I very much like the first part of your statement or question, and I disagree with the second part. So yes, we cannot forecast these things, as I showed. The ability to even forecast the next quarter is exceedingly poor. I showed you the consensus forecast success, which is negative. It's a total flop. I disagree with the idea that there's a better model that can do it, which is, I think, what you insinuated. Essentially, the economy is a complex system, and it changes every minute of the day, and that complexity can't easily be conquered, perhaps never. With each new wave of technology, there's new promise that this time we're going to be able to do this much better. I really think we won't be able to do that. And just to give this a little more credence, look at the inflation problem. The Phillips curve completely, utterly flopped, but so did monetarism. right? Monetarism is still being hammered into the students into the heads of students all around the world, and the Phillips curve is still taught and still will be taught. But on both sides of the spectrum, any model-based forecast really did not serve you well. All of it was situational, all of it was embedded in the political economy, all of it was embedded in history and institutions that history has generated. I call that economic eclecticism. That's one of the themes in the book I mentioned. I generally don't think that we're just sort of inches away from finding the one approach that will allow us to forecast. Economics remains full of uncertainty. For some reason, economists tend to be ashamed of that fact, that they can't forecast. They shouldn't. They should take pride in the fact that it's a complex system, and the best you can do is try to conquer the uncertainty and live with it and be positive about it. That's sort of my view on that.
Would you, Dr. Ashima Goel would like to respond to this person asking about the importance of trade credit and, sorry, you had a follow-up question or remark to make, Michael?
Just very quick response.
Yeah,
I broadly agree, absolutely. The only difference I would add is that within the traditional framework, of course, the assumption is there just won't be a recession. I mean, we know there will be at some point, or the policymakers do, but they do ridiculous things. And I'm talking G7 far more than emerging markets here. But just presume because the models can't show them, their staff will never show them. When they come, they're always a surprise. I'm smelling some Austrianism from what you're saying there, which I fully support and agree. But of course, Austrians do know what to be looking at, which is R and G, et cetera, et cetera. Why isn't that being used by mainstream central banks?
Well, brief response. I mean, look, I think when we look at economic forecasting, I like to distinguish between official forecasts and private forecasts. The private sector gets it wrong all the time, but there's a huge distribution of forecasts. I used to be a sell-side analyst on Wall Street, and I was, publishing forecasts against, dozens of other forecasts. And over time, you see a distribution, you see skews, you see different methods, and every so often you find somebody who you think, well, they got the narrative right, and you go by that North Star. But I think official forecasts are politically constrained. They're not going to predict a recession because, well, you can't do that. So there's limited use to that. Not saying that private forecasts are across the board better, but clearly they're not constrained as much as official forecasts. So there's a lot of complexity in the forecasting world.
I'm going to request both Dr. Ashima Goel and Francisca to respond not only to the last question, but also to the general questions posed by the first three audience members.
Yeah. So should I go
Please go ahead.
Yeah, so I think your question and Theer's question are pretty similar, that there's so many problems and you are saying monetary fiscal policy is working fine. The issue is that there have been real shocks we've lived through, pandemic, wars, geopolitical, so people are going to be unhappy. But I think we should also recognize that policies have done better than expected. I agree with Philip that all forecasts have flopped. In India also, people were repeatedly predicting the financial sector is going to collapse because we had NPAs in the last year. Growth is going to collapse, it's going to be negative. And none of that has happened. So we've shown the ability to policies to effectively counter shocks. And that is going to help going forward. There are shocks, there are dangers lurking there. But we seem to have some tools to help us deal with them. Then this issue of theory, demand versus supply, I think that you need to generally set conditions for people to for people to respond better, for workers, rather than forecasts in models, and that works much better and takes account of both demand and supply. So related to the credit question, I mean, we found that as conditions were loose in monetary financial conditions, credit growth really grew. We found personal credit loans were growing at 30%. Now, one of the factors that we know is that whenever there's very sharp credit growth, it leads to higher risk and potential NPAs down the road. So what the RBI did was prudential tightening just in that sector. But then it should have been accompanied with a relaxing of the overall monetary tightening, the rate, which was not done. So there was financial, cyclical, fiscal tightening because of the election year, and that is why we're seeing a slowdown currently in the economy. So again, I think that it's a combination of structural supply-side factors. We have a lot of room there to improve inflation. I think if the fisc would only focus on long-term, developing vegetable supply chains, they would not feel the pressure in the short term to bring food prices down. And then we wouldn't face these repeated inflation shocks. So there's a combination of supply and demand side factors that, you need sort of common sense, I think, more than models. Yeah.
Do you have anything to add to any of those responses, Francisco?
Yeah, just very briefly. So I agree with Ranil that in the last 10, 15 years, we've had plenty of practice with responding to short-term shocks. The problem is the long-term, for two reasons. One is that the mechanisms for responding to these short-term shocks are being increasingly constrained. Once by the debt, that's the demand-side policy being constrained, but also by the structures around us, like, for example, the flexible trade system that dissipated commodity shocks. So that's the one concern about the long term. And the other concern about the long term is exactly what this gentleman mentioned about the supply side. It's how to generate growth on the supply side, not just on the demand side.
So I wanted a couple of more members on the audience to ask questions if they are interested. One is Mr. Kaushik Das from Deutsche Bank and Dr. Dhammakirti Joshi from CRISIL. Very quick questions, please. Mr. Kaushik Das. Can someone pass the mic to him, please? Yeah.
Thank you, Anand. I didn't want to ask a complicated question, but President Trump is coming next year, and Scott Bessent, the new year's Treasury Secretary, he wants to bring fiscal deficit down over a period of time in US to 3% while maintaining growth at 3%. Is that possible when President Trump wants to cut taxes as well? So that's the fiscal policy side of the question. And from the monetary policy side, we know that tariffs are coming. Will that be inflationary for the US? In that case, if US interest rates remain at 5%, do you see the risk of growth interest differential being a problem for the US? And to Dr. Goel, the question for EM, if US interest rates stay at 5% for a long time, why should we expect any flows to the EM part of the world, given the interest differential? Because our currency is also going to depreciate. So in that sense, can we expect a lot of depreciation of the currencies in this part of the world?
So you have two questions, one for Dr. Philip Carlson and one for Dr. Ashima Goel. DK?
I think I'll press on the question on forecasting, because I think that's an existential question for us also. Now, I think, would it be correct to say that since we don't have control over many parameters that are going to play out, so judgment will have a much greater role in whatever outlook you produce. So forecasting will be, in some sense, more a work of art than work of science going ahead. Is that the right way to look at it? And what does it mean for central banks then? Will their policies be also more unpredictable?
So Dr. Philip Carlson can go with both the questions, and then Dr. Ashima Goel will respond to the question on emerging economies. Yeah.
So thank you for those questions on the deficit and on tariffs, right? So in one word, can you achieve 3% deficit with what is stated policy aims? I think no, you cannot. There's nothing wrong with having an ambitious target. There's nothing wrong with that. But even if you just look at the policy agenda pre-election between Harris and Trump, neither of them would have delivered 3% growth. Nobody's willing to score 3%. The CBO isn't willing to score 3%, and that won't happen. It can turn out better than anticipated if you actually manage to rein in spending, or if you manage to cut out cost rather than rein in spending. So, the Department of Government Efficiency, well, let's see what they can deliver. There have been other such commissions in history before. Maybe they will manage to cut out a large amount of cost, but not, in my view, to the level where you'd have a 3% deficit. The other 3% targets, by the way, are realistic. The 3 extra million barrels of oil, I think that's doable. And the 3% growth, in my view, too, is doable. I've been bullish on this economy all through 22, 23, and 24 with a non-recessionary call for the US economy. I have not changed my view on that. I think 2025 will be another outperformance of expectations for the US economy, which is structurally in a very sound spot. On the tariffs, I think essentially we need to be careful when we say inflationary. Do tariffs lead to higher prices? Yes, I believe that. They're going to be passed through to consumers. In that sense, prices will go up. But let's be very careful what inflation is. Inflation is a change concept. It's a sustained change concept. So one-off tariffs are a one-off shock to the price level. If you don't follow up with tariffs the next year and the following period, it does not make inflation, right? It's a one-off shock to the price level. If you're done with it, you're resetting the inflation game. So I think, yes, it's a one-off shock to the price level if they all come at once. It's a shock to consumption, a downward shock or downward push to consumption, and it's also a headwind to growth. But again, if you don't repeat those year after year, they don't become inflation and sustained growth slowdown. In that sense, I conceptually am not super worried about it, and the political economy tells me you will not get those tariffs as advertised. Like the 20% universal plus 60% on China is a possibility, but much more likely is the fact that over the course of the year, this will be watered down in some shape or form, where you land, yes, at higher tariffs, but not to the extent that I think we've seen it articulated on the campaign trail.
Okay, I'm going to probably ask you to respond to DK's question about forecasting being art or science offline, because the organizers have whispered into my ears that I'm overstaying my welcome here on the podium.
Absolutely.
On the stage. So I'll probably ask you to make a quick last response to Kaushik's point. Ashima, you want to, on the emerging markets?
Very briefly, we've seen, I was just looking at the data, there's a kind of really V-shaped in FPI inflows to India over the last year and a half. They've always come back after they've gone. Last 2 months, it was a slightly sharper dip, and then they're returning again today. So to say that because US Treasury rates are high, inflows won't come, that's not true. It depends on our growth also. It depends on they want to diversify. And they also tend to react excessively to a rise, but then they rethink and come back. So, yeah.
Thank you. So I think this session has been as much enriched by the knowledge, wisdom, and experience of the panelists on this side of the divide as much as the questions that came from that side of the divide as well. So thank you all very much. One thing that is becoming evident is that as we put behind us the paradigm that prevailed in the last 4 decades and look ahead to a period of uncertainty, I think humans also have to make that leap. When the world is becoming discontinuous, humans usually find themselves lagging a step behind. Even if we agree that all signs point to discontinuity, probably it takes a little bit of time for us to readjust our lens and also what we have been used to. So in that sense, that is itself an important risk factor, which I hope doesn't necessarily play out, and what we witness is incremental change and not discontinuous change, although my instinct tells me that we are in for a period of discontinuous change, and therefore some of the things that may have served as well, arguably, to put it very politely, may not necessarily serve as well going forward, and we need to be a lot more flexible and open-minded to abandon what doesn't work anymore, because economics is about public welfare and not about adherence to a particular ideology that may have evolved due to different compulsions. So with that note, and since we are 6 minutes behind the extra time of 5:50, I'll stop here. I hope you all enjoyed this session. Wish you all a very pleasant evening. Thank you very much for being here.
Can we have a round of applause for this extremely interesting and very, very popular, obviously, session which was going on. Thank you, Dr. Nageshwaran, and all the panelists for the session. May I request Dr. Nageshwaran to kindly hand over a token of appreciation to each of our panelists, please. Ladies and gentlemen, we now move on to our next session, Unlocking the Potential of India's Agriculture. And for this session, we have with us our speakers who are already waiting to join us on stage. I request all of you to remain seated because we will try and not keep you away from dinner or, too late. So let's try and do the rest of the schedule on time.
कौन है?
Working. Clicker is there. I'll explain it to Mr. Denning as well.
ये किसके लिए?
मैम ग्लेन डेनिंग विल प्रेजेंट फर्स्ट, उसके बाद प्रोफेसर रमेश चंद भी है, तो मेरे को बस ग्लेन डेनिंग को थोड़ा बताना है, ये ग्रीन बटन दबाना।
हाँ हाँ, उनको मालूम है. Ladies and gentlemen, we are ready to begin with our next session. For this session, we have with us Dr. Glenn Denning, Professor, School of International and Public Affairs, Columbia University, Mr. Ramesh Chand, Member Niti Aayog and Chairman, Institute of Economic Growth. And chairing this session is Mr. Sanjeev Puri, President, CII, and Chairman and Managing Director, ITC Limited. May I request all of you to settle down so that we can start with the session right away. May I invite Mr. Sanjeev Puri, President CII and Chairman and Managing Director ITC, to kindly give his opening remarks and take the session forward.
Good evening, ladies and gentlemen, and thank you for participating in this very important session on unlocking the potential of India's agriculture. Yeah, agriculture, as you know, is a very vital segment of the economy, and to provide insights on this very important sector, we have a very distinguished panel of thought leaders. Before I invite them to share their thoughts, I'd like to make some introductory comments setting the stage for our discussion. India's agriculture sector has been the backbone of our economy showing remarkable resilience and adaptability. Having the world's largest arable area of 156 million hectares and 15 diverse agroclimatic zones, the sector has achieved an impressive average annual growth rate of 4.18% over the last 5 years. Agriculture today contributes to a much smaller component of the GDP than it used to do in the past, but continues to employ about 42% of the workforce in India. And this is a trend that is commonly observed in nations that traverse their development paths. The sector has also been very progressive in diversifying exports. Agri-food exports, including processed food exports, during 22-23 was US dollars 46.5 billion, accounting for 11.7% of India's exports. And this progress that we have seen over time has been enabled by some very innovative interventions to create farmer linkages, bring in technology, bring in investments across the supply chain. And despite the progress that this sector has made, I think there is tremendous room to grow vertically. And this is absolutely required to realize our Honorable Prime Minister's vision of having at least one made in India food product on every dining table of the world. So we have to address these challenges of raising the bar on productivity, quality, and at the same time deal with the newer challenge and a very severe challenge that this sector faces of climate change. It is a sector that is most vulnerable to erratic weather patterns. And all these issues are no more things of the future. They are live and with us today. So whilst we deal with productivity, we also need to think about sustainability, and we need to think about how the whole practice of farming has to transform such that it's more environmentally friendly. Technology, no doubt, is a powerful tool to address and unlock the opportunities. Therefore, harnessing new-age digital technologies to provide innovative and comprehensive solutions to farmers is one important pillar, and purposeful government support over the years for startup has enabled tremendous progress. Today we have 2,800 registered agri-startups which have developed numerous solutions to improve agriculture productivity. We are also seeing collective efforts of stakeholders coming together, farming collectives, policymakers, private sectors, developmental financial institutions that focus on agriculture, all coming together to co-create solutions. So no doubt progress has been made, but we still have challenges. And more importantly, I think it's important to recognize the quantum of opportunity that is available. Now, there are various estimates on how much world food production needs to increase by 2050. And it's by order of magnitude. And this has to be done at a time when natural resources are depleting. And there lies a big opportunity. And given the potential that India can grow vertically from about 2-3% of global trade, can we multiply that? That is an indeed tremendous opportunity. There is growing requirement for traceability, sustainable farming, and so on and so forth. So can we set up systems and processes and use technology to provide such solutions? We need to build resilience in agriculture, because that is a very serious concern. Food and nutrition security is a serious concern across the world, and it's also something that's making food inflation sticky. What in particular can we do with horticulture? Again, an area of tremendous opportunity, but has its own nuances and challenges because we're dealing with a perishable cross. And more importantly, we know in India there are a large number, millions of small and marginal farmers. How can we work with them? How can we enable them and make them productive, make them future ready? These are certain areas that I think that offer, the solutions offer great opportunity for the growth of this sector to the benefit of farmers, benefit of society, and also exports in the country. And to provide insights, to deliberate on some of these issues, and to enable some concrete thoughts to emerge, to develop a decadal roadmap, I have great pleasure in inviting, first of all, Dr. Glenn Deming to please address us.
Distinguished guests and members of the CII, ladies and gentlemen, I really appreciate this opportunity to participate in these important discussions on unlocking the potential of India's agriculture. And I'm really honored to be able to share a few thoughts on this topic. So I wanted to begin by reminding all of you the fundamental purpose of agriculture, and that is to provide food security. Food security. Now, we all obtain food security or achieve food security in different ways. There's basically 4 ways of achieving it. Number 1, you produce the food. Number 2, you use agriculture to sell food, to be able to generate cash crops. Thirdly, like probably almost everyone in this room, you work for a living, you have an income, and you buy your food. And the 4th category is social protection, where you're not in a position to be able to afford the food that you need, and others, such as the government, would step in for that. So all of these, in one way or another, enable us to achieve food security. And for all of these, we depend on farmers to need it. Now, often food, and you hear about it a lot, especially these days, food can be a weapon of war, a weapon of war. But food security can also be a platform for peace and prosperity. And if we neglect food security, we do so at our peril. So basically, I've arrived at this idea of universal food security. It really builds on a lot of work that's been done in the past, trying to define what exactly do we mean by food security. So I look at this as being a world where every person enjoys a healthy diet derived from sustainable food systems. That's my simplest definition of food security. It's a simple definition and it's easy to say. It's more challenging to turn that into action. So, working through the literature, consulting with experts from all over the world, and also drawing on around 40 years of my own experience in Asia, Africa, and elsewhere, I've really come to the conclusion that we need to invest principally in 5 areas, 5 major areas within the food system in order to achieve transformation of the food system, ultimately to reach universal food security. Now, those 5 areas are sustainable intensification. Now, for many of you, that sounds like an oxymoron. How can you intensify but still be sustainable? But honestly, we have very little choice. We have very little choice in India. You have very little land to expand to. So the only way is to intensify. The challenge, of course, is to do so sustainably, which involves much more efficient use of inputs, including water, including nutrients, including energy, including even labor. It requires climate-smart agriculture, agriculture that does not further cause damage to the environment. The second area, of course, when you produce the food that you need, is how do we market it? So market infrastructure. This is basically connecting farmers to markets. It requires physical infrastructure, roads, rail, electrification, ICT, information communication technologies, and all of the soft infrastructure that's needed to make those systems work. The third area is post-harvest, what I would call post-harvest, reducing post-harvest losses, including food loss and food waste. And the tragedy here is we basically throw away about 1/3 of the food that we produce. So all the energy, the nutrients, the water, the labor that went into that is lost. And there's ways in which we can reduce those. Healthy diets. This involves a convergence from undernutrition and overnutrition. Yes, we have overnutrition. We have the double burden of malnutrition. In India, tremendous progress has been made over the last 20 years, reducing the level of stunting. It's now down to about 35–36%. But that's still tragically high. That means 1/3 of children under the age of 5 are off to a very challenging start to their lives in terms of educational opportunities, in terms of livelihood opportunities. So reducing that is absolutely essential for achieving universal food security. And finally, social protection is really geared towards all of those folks who are not in a position to achieve their own food security. Healthy diets from sustainable food systems. Plus, we have a number of cross-cutting issues, including gender equality, including good governance, including broader areas of education and health. So this basically tells us what to do. All right, so in this cartoon, we see these two people talking about how we move from what we know to what sort of an outcome we want. Yes, we can just wait for a miracle to occur, or we could be much more proactive. Now, this is the great challenge now. I think we have all the information we need to be able to transform agriculture in this country. Very strong research systems, strong institutions. In 1967, this book was written about India, about food security in India. It was a bestseller. It was called Famine 1975. Look it up. Two Americans wrote about India and described it basically as impossible. Basically, they had different categories. They said, in the end, it can't be saved. Can you imagine that? 1967. 50 years later, India is the largest exporter of rice in the world. Okay, so that's the sort of transformation that is inspirational. But obviously it's not enough, right? It's not enough now. Here we are in 2024. 50 years on, we still require smallholder farmers to contribute, not just to food security in India, but also to transformation of the food system in India. They need technology, they need incentives, they need stronger institutions. But ultimately, we still need smallholder farmers. Smallholder farmers are here to stay for a long time yet. So I believe that if we invest in smallholder farming, we connect them to markets, we reduce post-harvest losses, we work on improving our diets to become healthier, and we connect all of this to social protection systems for those who aren't in a position to help themselves. I think truly we can lift this nation to another level of peace and prosperity. So that's my challenge. I think we're in a great position at this time to be able to realize that potential. Norman Borlaug, who won the 1970 Nobel Peace Prize, used to say, basically, you can tell me about potential all you like, but you can't eat potential, right? So we have to translate all of this into food, into healthy food from sustainable food systems, universal food security. Thank you very much for your time.
Thank you. Thank you very much for that very insightful address and the very interesting framework that you had put in place. I now have great pleasure in inviting Dr. Ramesh Chand for the special address.
Good evening to all. In fact, I'm surprised to see interest in this session. I was mentioning to Puri Sahab that this being a last session, maybe we will not have even half of the seat filled. But I'm really impressed by your interest and dedication toward the theme of the conference. Since the clock is ticking, I straightway come to the theme of my talk. Before I go to the exact theme which was suggested to me by Mr. Ajay Seth, he asked me to speak on irrigation and sustainability, but I find the mood in the room is to just know what is happening in agriculture. So briefly, I will share with you what are our achievements in agriculture and what are the important lessons from that for unlocking potential of agriculture. So if we look at the growth of Indian agriculture, Mr. Puri also mentioned about it. The growth rate has been accelerating, particularly in the last 2 decades. So last 10 years, we have historically highest growth, depending upon what year beginning and end year you take, what method you use. I can safely say that the growth rate of Indian agriculture is now close to 4%, which never happened for a decade earlier. But under this very nice information of having historically highest growth, there are many, many challenges. And if those challenges are not addressed, then I think the cost of not addressing those challenges will be much bigger than what is the gain from this historically highest growth rate. So what are those challenges? First is, I did detailed analysis. Under every statement I am making, there is a lot of empirical work. This growth rate of last 10 years has not been driven by technology. It is driven by prices. Real prices of food in last 10 years has increased by 26%. If you combine these two, growth rate at constant price and growth rate in real prices, the income of farmer in India in last 10 years have increased by close to 6%, which again, to have 6% growth in income in agriculture is not a small kind of things. So this can't be afforded. That brought us high food inflation. That has its own implications. So first challenge is that this growth rate, which is price driven, we have to make it technology driven. The second is, if you look at the efficiency, like I looked at efficiency in terms of what is the real cost of production of 1 ton of major food, the trend is that that cost is rising. If the real average cost of production is rising, you lose competitiveness, and obviously then your growth gets linked to increase in price. Without increase in price, you can't induce farmer to increase the yield. That is the second challenge, low efficiency or poor competitiveness. Third is the challenge of sustainability, that if we look at water, if we look at land, air, what has been happening there, that is not very healthy, rather that is very, very unhealthy. Fourth, this growth rate is not broad-based. This growth rate has not happened this kind of growth rate has not happened on 94% of area. It has happened only on 6% of area which grows fruit and vegetable. It has happened in livestock. It has happened in fishery. But it has not happened in cereal, oilseed, and pulses, which are our convention agriculture and which are face of Indian farmers. There is fifth challenge also, that is the challenge, fiscal challenge. We all know subsidy have been rising, price support. I have not mentioned that here. Then people start saying if you are discussing support to agriculture sector, you let us know what is the support government is giving to industry. So since I didn't have that complete data, so fifth challenge I have not mentioned here. If now I look at if I disaggregate this growth in agriculture sector in terms of what happened in different segments of agriculture, you see the first segment, as I said, cereal, pulses, oilseed, cotton, sugarcane, this kind of crops are grown on 94% area, but the growth rate of 94% area has been on an average 1.6%. In many states, the growth rate is 0. In 4 states, the growth rate in this segment in last 10 years is negative. Now the issue is that if those farmers who are doing cereal, pulses, and oilseed are also doing little bit of horticulture, also doing livestock, then their overall income will increase by 4% because they are also doing little bit of those things. Again, the information about that aspect is 47% agriculture household of this country neither do horticulture nor they do livestock. So they are our focus area, that how we improve economic conditions and income of those farmers who are growing only cereal, pulses, and oilseed, not doing horticulture, not doing livestock. We are working out a strategy under leadership of our Vice Chairman, Shuman Beriji. Incidentally, he is here, how to address this kind of things. But this is a challenge which I just want to share with you. So as a result, a very strong division has emerged in agriculture. One is the segment of agriculture where you find sluggish growth. At state level, as I mentioned, you find 0 or negative growth. And there are large number of districts where this segment of field crops shows negative growth. So we have to address it. We are doing something to address that. On the other hand, we have a vibrant sector of horticulture, fishery, and livestock. So we have to see to it that the field crop farmer diversify in that direction. Then India has now reached a stage where mindless pursuit of growth may not be desirable, it may be harmful. So we need to see that we are not only chasing the objective of growth, we are chasing the growth plus. So what are those plus? One is that growth should be efficient, growth should be cost effective, growth should be sustainable, and growth should be inclusive and broad-based. Those are the challenges which are there. So if we have to address those challenges and unlock potential of agriculture, we need to work on 7, 8 areas. One can put in a different way, but I just broadly put it. To my mind, irrigation comes at the top. I did some exercise to see how much irrigation matters today. In case of irrigation, the work of Waterman of India, Professor B.D. Dhawan, he did calculation that in India, productivity of irrigated agriculture is 2.5 times the productivity of rain-fed agriculture, considering all the changes which happen because of irrigations. If I use that coefficient and I use another number that 55% area is irrigated, 45% is rain-fed right now, bringing 1% additional area under irrigation, say from 55% right now to take it to 60%, will result in 3.2% growth rate, elasticity being 0.8, quite strong. because now major area is under irrigation. So one thing which is rising is smaller. So you get elasticity less than 1. It is 0.8, which is quite substantial. Then there is technology, including frontier technology, and we know technology is the prime mover. It creates possibilities. That is the second. Then we have policies, infrastructure, institution, investment, public investment, household investment. But is more important for future, for unlocking potential of agriculture is private corporate investments. In fact, share of private corporate investment in agriculture, which basically is production agriculture, that is the definition of CSO. They don't consider investment in warehouses, marketing, etc. That comes under different category. So when you talk about investment in agriculture, not for agriculture, share of corporate sector is only 1.5%. In fact, out of the total investment of corporate sector, only 0.3% are invested in production agriculture, whereas we have very strong evidence from ground that wherever private corporate sector invests in production agriculture, you have very big gains. Again, there are papers from Niti Aayog. One can see to it in which state, why Andhra is having 7%, Punjab is having only 0.5%. Those are the kind of growth which give clear messages about the importance of corporate private investment in production agriculture. And lastly, very important, rising role of exports. Why I am writing this is that our last 10-year growth rate is 4%. Our projections are that in next 10-15 years, growth rate is likely to fluctuate around 3.5 to 4%. This is almost 4 times the growth rate in our population. And if I consider income effect and population effect, the demand for food in India is likely to increase by around 2.25%. So if output is rising by 4%, demand is rising only by 2.25%, we have to find market for a remaining 1.5 or 1.75%. And again, our calculations are that India in the coming decade will be required to find overseas market for 1/3 of incremental production in food sectors. And if you want that kind of thing, you have to be competitive. This also has a message for sustainability that even if India's growth rate, some compromise has to be made for sustainability. India right now is in a position to do that if we want to address the issue of sustainability, which is very, very important. Now coming to, in next 3 minutes, coming to the exact topic which was mentioned by Ajay Sethji, that I should speak on irrigation and sustainability. Role of irrigation is very well known in our country, how it has grown. But this is one role. Mr. Puri also mentioned about resilience. You see how irrigation brings resilience. Between the decade of 70s and the recent decades, the irrigation has increased, almost doubled. If we look at the instability in agriculture output by using the standard statistical method of instability, it has come down from 10% to 3%, 1/3. So this is how you gain this resilience by developing irrigation. So that's why irrigation is so important for resilience and for adaptation to climate change. Then coming to sustainability, agriculture is very, very important. I don't know how much time we have, why it is important. Let me share with you some facts. For the world as a whole, the share of arable land, cultivable land in the total land is 10%. In India, it is 58%. So when more than half of the land is put to a one sector agriculture, then the land which is needed for ecological functions, other kind of function, hardly exists. So therefore, additional burden comes on agriculture that this sector need to take care of those kind of functions, also biodiversity, ecology, and many other things, simply because we don't have land mass to take care of those kind of things. Then water, we know that in summer, sometimes we have to run train from one district to another district to meet water requirement of people, but then we are using 80 to 90% of water in agriculture. In some year it is 80, in some year it is 90, most of the year it is in between. So that is the figure we have. And as far as greenhouse gases are concerned, again, India's agriculture share is not insignificant, it is around 14%. Then there are rising threats to sustainability because of water table going down, land degradation, so many practices happening. But one practice which I want to share with you, that how traditional agriculture was more sustainable. In 70, when we started Green Revolution, the nutrient which we derived for our food production from organic manure were 4 times the nutrition which we derived from chemical fertilizers. Today, it has changed 8 times. Now the nutrient which we take from chemical fertilizer is 2 times the nutrient that we take from organic manure. So this kind of things are not sustainable, that today we have reached a stage where we don't care about manure and those kind of things. So like this, there are so many issues. I would only like to take just 1 minute that how we can address the situation. The answer lies in improving efficiency of water use. If you look at how much water you use to produce 1 ton of food, as you can see in the slide, to produce 1 ton of food, we use 1654 cubic meter of water. China use less than half. So you just see, because we use flood irrigation, we have free power, we provide strong incentive to farmer to pump out as much water as you can and spoil it. So sadly, because of those kind of things, our water use efficiency is so low that if we are able to, say, move closer to water use efficiency of China, then not only we can provide har khet ko pani, 20% of water will be surplus for other sector, which means the water availability for other sector will double. So those are the kind of number that because of 80% share of water, how much agriculture matters. And some efforts are happening, particularly during last 10 years. Earlier I missed that slide, that for 25 years, area under canal irrigation was not rising. But then vision of our Prime Minister, he said all these things have to be reconsidered. Let us go for new way of doing things, last mile connectivity, development of catchment area. So how things change, you can see for 25 years, we spent thousands of crores of rupee on irrigation, public irrigation, but area under canal irrigation declined from 18 million hectare to 16 million hectare. What a waste of resources. So when in 16, PM came with PMKSY, you just find how much change has happened. And every year we are increasing 1% area under irrigation. Similarly, in micro irrigation, you just see that how much increase is happening every year. In the last 7-8 years, 1 million hectare area every year is brought under micro irrigation. Those are the ways to achieve higher efficiency in agriculture. I think I should respect time and just last slide, that in order to harness sustainability, the major determinant of sustainability are technology and policy. Sadly, the kind of technology which we have been doing, it was maximizing yield. it was not looking at how much resource is needed to achieve that increase in productivity, because scientists used to show their performance with two indicators: what is the increase in yield of the variety I have developed, and second, on how much area this variety is grown. They never looked at whether my variety resulted in 4,000 liter water per kg of rice. Earlier it was 3,500. They never look at those kind of things. So we have to change that kind of approach. Second is policy, subsidy, etc. But now we are realizing this threat, and government has come out with the sustainability mission, and several other things are being done. Lastly, I want to say that we cannot address the challenge of sustainability, which means we are compromising interest of future generations, sacrificing their interest to have higher growth for present generation. For that, we need to have agroclimatic regional planning. Today, rice is grown in the area where rainfall does not meet even 10% water requirement of rice. So those kind of things are happening. We are growing groundnut in Jodhpur district. We sow it in the month of April and harvest it in month of August, when Jodhpur doesn't receive any rainfall, otherwise arid region, because of subsidized irrigation. I think those kind of things must go. Solution exists, but people, government, and this nation require bill to address these problems. Thank you very much.
Thank you. Thank you, Dr. Ramesh Chand. I think that was a very, very comprehensive presentation in such a short period of time. You covered the challenges and also the key action areas. So thank you very much for that. We have some time now for question and answers. Questions from audience is welcome. But just before we start with the audience, I'm just going to pose one question each to the panelists, and then we will come to the audience. So, Dr. Glenn Deming, you had given a 5-pillar framework for food security, very comprehensive. Now, what do you think is required to make that happen? Are there any global examples, global case studies where we can draw on how this whole framework could be, or these elements could be put to action?
Yes. That's the great challenge. Those 5 areas, as robust as they are, all have to be implemented in context. So what is good for India is not good for Malawi, is not good necessarily for Brazil. So understanding local context is important to come up with the specific kinds of interventions, many of which Professor Chand mentioned, but placing them in context, biophysical, socioeconomic, political context. How does it actually get done? Well, I think it's obvious even by the audience here. We need to have government playing a role. We need to have business playing a role, much more than they had during the Green Revolution, connecting farmers to markets. We need to have higher education institutions involved. And when it was all boiled down, it requires top-down and bottom-up. But I think most of the work, most of the successes I've seen have been done at the national level and at the sub-national level. So the key conclusion that I came to was that it was all about leadership, was all about enlightened leadership. And that's why, I put a lot of my personal effort into building a new generation of leaders who can understand the kinds of interrelationships, who can understand the importance of working across different sectors, who are committed to impact. And I think that involves really working with the design, the curriculum of higher education. The kinds of people that will end up working in government, will end up working in the business sector, will end up working in private sector organizations. They really have to have a much better conceptualization of the complexity of the food system and, you know, to reach across institutional barriers and sectoral barriers and disciplinary barriers to achieve an impact.
Thank you. I'll now come to Dr. Ramesh Chand. I think you made a very, very interesting observation that the private sector investment in production is only about 1.5%, and where the investment has been higher, agriculture has grown at 7%. So that's a very, very interesting insight. So the question I have for you is that what do you think is required to enable greater private sector participation in this area? How can private sector play a role in bringing technology, innovation, and greater participation in this?
You see, we all know that private sector in its investment is mainly driven by profit motive. And profit will happen if private sector is allowed to do business in agriculture. If you are not allowed to do business in agriculture, then of course some investment as a corporate social responsibility can come, but not the major investment. Sometime back I published a paper in Business Standard, Plowing Private Capital into Agriculture, where I talked about, without naming them, but today I can name it because everybody knew whom I was referring to, that was the role of Jain irrigation in banana revolution in Jalgaon districts. You see, the kind of things which they did, today Jalgaon is the 5th largest banana producing country. Only 4 countries of the world produce more banana than Jalgaon. Otherwise, Jalgaon is head of rest of 100 countries in producing banana. How that was made possible? Because Jain irrigation supplied them disease-free, tissue-cultured banana saplings. Then they also invested a lot in drip irrigation and those kind of irrigation. Most recently, I have experience of Andhra Pradesh, which has highest growth for agriculture sector as a whole. Last 10 years, their growth rate is 7%. To get 7% growth in agriculture is not a mean thing. So how they did it, I made 2 visits. One, I interacted with Jaganji and then with the present CM. They are involving more than 12 corporates in having some sort of formal or informal contract with the farmers for seed distribution, quality seed distribution, supply of plant propagation material, land holding for planning and implementing drip irrigations, advisories for crop planning, advisory for control of pest diseases, and also in many cases buying produce from the farmers. So I was told by state bureaucrat, which I find on the ground, that state facilitate lot of informal kind of understanding between farmers and private corporate sector, that if farmer will prefer, they will buy the produce from the farmer at some pre-agreed price, which can be negotiated at the time of actual transaction without formal kind of contract farming. So this way, there are numerous ways. And we also know that future growth will come from knowledge-intensive agriculture, science-intensive agriculture. The sad state of agriculture in states is that extension has collapsed. Extension posts are vacant. If you ask an extension person why you are not visiting farmer, he will give you very good reason. I have no car. I have no jeep. If I have jeep, I don't have money for putting diesel or petrol into it. That is the state of extension. So who will take the technology from lab to land? I think the role and necessity rest with the private sector. The center and state government should see to it that this role is facilitated. This is how you can play a role.
Thank you, Dr. Ramesh Chand. So I'll now move on to the gentleman here. Can you come in? You may please introduce yourself and then the question.
Thank you, Mr. Puri. Very good evening. I'm Rahul Banerjee. I lead a think tank in Delhi, Vaisana House. I had a two-part question. You took the first part. I will come to the second part. Mr. Chand, increasing farm output or even agricultural output, if we want to double it, we need a very good infrastructure as well as a manpower. So we have a very large population of individuals in India who attend higher education institutions specializing in agricultural technology or agricultural science, but do not actually get back into the agricultural ecosystem. How do we attract more young individuals into the ecosystem who can come into the ecosystem and practice agriculture as a profession? Thank you.
Shall we take one more question then together? I think that gentleman raised his hand first, so after that you can come.
Mr. Puri, you had referred about traceability, and Mr. Chand referred that exportation of our agro-produce is required and will be more acute need in days to come. But there wasn't any deliberation on the solution how we can get rid of the traceability issue that we are having today in export markets, mostly in developed countries. One of the thought I have is that if we can use the drone-based digital mapped landholding data and can utilize that thing in terms of traceability, though it's not so easy, just a thought I'm saying, because we need to get a solution to, just because our export competitiveness is going down in that case. Secondly is the water where the agro-producers are grown that's contaminated with urea and pesticide. One solution is that if pesticides can be, sprayed through drone. But apart from that, that's more with the land part. What about water? Because contamination is there in land and water. Even though the farmer is taking the best precaution in terms of growing the produce, which will be adhering to the standards in the developed markets, just because of water contamination and land, we do get these challenges. So your thought on this? Thank you.
So, would you like to go first? Yeah.
This first question regarding youth and people who study in agriculture education, going back into agriculture, the fact is that now people doing master's degree, PhD degrees are not getting jobs. This is again another sad state of agriculture. Yesterday, I was discussing with the head of Department of Biotechnology in IARI. She told me that their PhD student, after doing PhD, are not getting any job. In universities, the jobs are declining. In ICR, there is a saturation. We need them, but the system, the way this public system is going, that's why I feel it's not that suddenly I have become enamored by the private sector. I find the solution will come from there. If we allow private sector to operate in agriculture, you will find that they will set up their labs, they will go for production of high quality seed, they will go for high quality advisory. Some market will be created for using that talent for agriculture. Do not expect a person after doing BSc, MSc or PhD that he goes back to farm and he becomes a farm manager. His skills are different types. That skill-based farming, that is another dimension that is needed. But I think for these kind of people, high quality jobs, we really require that private sector should undertake some activities, including quality seed production and its exports. You ask a seed producer in Hyderabad belt, you will find that many of them, they are employing the postgraduate PhDs in quality seed production. So we need those kind of intervention, but at the same time, we need to address the problems of state level absorption and use of this talent. What is happening, every university has divided its universities in 3 fours. First agriculture university, then there is horticulture university, there is forestry university, there is fishery universities. You have created so many universities. If you ask for money, today people are not willing to join as a vice chancellor. They said state is not giving us adequate money and I have to beg from so many sources to give me money and I am not getting. Really, this R&D system has gone into bad shape. So it is, I think the problem is so complex. I am happy it is being raised at this forum also, that we need to take a serious view. Center and state need to come to some agreement. Though agriculture is a state subject, now the 50% budget of state agriculture university is given by ICR. Whenever they try to squeeze, they are saying, how we will do research if you are not giving us money? State government is not giving us anything more than mere salaries. So I think we have reached a complex situation, and whatever best growth we are saying, as I said, mainly it is price driven. It is diversification driven. In case of R&D, there is a technology fatigue which is setting in, which can be very dangerous if it is not addressed on time. Then this second issue of traceability, since time is less, I will just address it in a larger dimensions. You will just find that as income of people increases, awareness about role of food increases, a shift takes place from quantity to quality. Today, if you want to double your income or triple your income, you can't do that by increasing quantity. You see, even if you use best variety, your yield will increase by 20%, so your income may increase by 15%. To increase that yield, you also require additional cost. But if you are able to target consumer with a particular attribute, with a particular quality, you can take double price. You can take 3 times price. It is happening. You look at what is the price of milk sold by Country Delight compared to milk of same quality that is sold by Amul or Mother Dairy. They are getting much, much higher price. Similarly, people are now working toward that. Sometime back I did a study that in next 30 years, what will be the increase in total food demand? In that total food demand, when it was not matching with the increase in quantity and expenditure, but I thought was that 1/3 of the food demand in future in India will be for quality trade, which also includes traceability and those kind of things. But if you are forcing farmer, the only option you have is you have to take your produce to APMC and sell it. Where this kind of infrastructure is not there, everything that sell is designated as a dada kind of grade. That will defeat the purpose of quality production. Few years back, India's great agriculture scientist, Dr. Basel, he was with CIMMET. He developed a variety quality protein maize, which was having 40% higher protein than ordinary maize. But from the look, you can't identify whether it is a quality protein maize or it is an ordinary kind of maize. So if you do not let value chain develop from farm to factory or farm to end user, farm to consumer, you will find that the incentive for quality is very difficult to pass on from consumer to producers. So we need to create those kind of mechanisms, direct buying from the farmers, development of those value chains, labeling, not only traceability, even labeling. Traceability, etc., it is happening at some low scale. APIDA, they verify some of our export consignments. It is happening at a slow scale, and there is clear evidence that safe food sells at a much higher price compared to food about which you have no information, whether it is unsafe or like that. So quality traits are becoming very, very important. I think it is the quality trait which are already empowering agriculture sector to play much larger role in economy than that quantity aspect of agriculture.
Thank you. Doctor, would you like to add something to this?
I think I would just say that the trend that you mentioned about sort of going back and becoming farmers, and it's sort of less popular than it was some time ago, I actually see a different kind of a movement towards food systems and food security. It's actually driven by the crises we have, and the high food prices and the opportunities in changing demands for products by urban consumers. So I actually think that it's actually a big growth area, and it's probably up to our higher education institutions to start to reflect that by promoting more and developing more kinds of interdisciplinary programs, building more business into agricultural programs, and I think they'll be, certainly from my experience doing it at an international level, I'm finding a lot of interest from people who are not even currently working in agricultural food. They come to me and say, I want to work in that area. And I tell them, well, don't necessarily do a PhD in genetics, but here's some opportunities of where you can really participate in the food system. It's a big ecosystem. You can work in government, you can work in the UN, you can work in the private sector, and increasingly you can be your own, you can become an entrepreneur. You can actually innovate and come up with new institutional models.
So we are actually out of time, but we'll probably take, but we'll just take two quick questions, be very brief to both of them. So we are exceeding the time, but let's go ahead and do it. Go ahead, please. Yeah, the mic.
I'm Arvinder Singh Brara, Chairman and Managing Director of Mantech Consultants. My question is that, we talk about sustainable agriculture, and we've had this problem of stubble burning, which has been polluting the already polluted environment of northern India, most of India. So my question is, I think there is a communication gap between the farmers and because there are programs to help them to use the stubble, but somehow that's not been communicated. So my question is, what can be done to get the farmers on board? Because at the moment they are, protesting and so on, so that's going to hurt the production as well as the issue of stubble burning. So what do you think is the way to handle this?
So let's also take the other question very quickly, and then I will pass it on to
Thank you. My name is Nalin Kohli. I have a question for Dr. Hennings. You mentioned towards the end about role of entrepreneurs in agriculture. And you think the Indian system where a farmer who can also become an entrepreneur, because everything is controlled for him. So the room for becoming an entrepreneur is very, very less. The seed price is controlled, the output price is controlled, the fertilizer price is controlled. So how do you promote entrepreneurship in agriculture? And particularly in context of India is now the third largest startup ecosystem in the world. And how do we connect these two to have more startups, successful startups in agriculture?
Would you like to?
Well, an entrepreneur works within whatever system there is. I would not, I do not think India is necessarily stifling entrepreneurship. I think that I see a lot of entrepreneurship within India at all levels. So what does it take to be successful? Obviously, you need an alignment of education systems. You need policies that are supportive. You need including finance that would become available for entrepreneurs. You need improved knowledge about market opportunities. I mean, I'm sure there are many entrepreneurs out there who don't quite understand what the market opportunities are. And so, most entrepreneurship ultimately has to be demand driven. So what sort of a niche can they fill? So I think it's principally education, it's policies. I think many of the technologies are here, and particularly probably the education systems haven't caught up with them. The digital technologies, the genetic technologies, you know, that we didn't talk about today, but I think are going to be incredibly important for the future of Indian agriculture.
Thank you. This issue of farmer agitation is complex, but let me see what I can offer as an explanation and how to address it. First, coming to problem of stubble burning, it always takes some time for any innovation to work on ground. Now the solution is available. The solution is compressed biogas. Market for rice stubble is now there. My own projection is that in next 6-7 years, there will be only deliberate farm fire. Otherwise, there will be opportunities for economic return to that stubbles. Already this year, the number of fire has come down in Punjab to 2,350, whereas a few years back it was 10,000. Now the fire incidents are increasing in Rajasthan, Madhya Pradesh and UP. In Punjab, there is a clear trend, and my feeling is that they have already set up 30 BCG plants. And those 30 BCG plants have capacity to use 40% of the rice stubbles. There are investments which are willing to go there and set up these plants. We also visited Punjab with our vice chairman, talked about those kind of possibilities. So that is appearing. But at some places, vested interests don't let it happen. For example, there was a plant in Ludhiana. So farmer protested, we will not let this plant to be here. It is spoiling our soil. Those kind of things apply to every industry. If we will not let industry be there, it will create problem. And producing biocompressed gas and taking slurry back to the field is the ideal sustainable solution for this crop residue. That in situ kind of arrangement doesn't work well, because if you are plowing back the rice straw into soil, when the organic matter will decompose, harmful gases will enter into environment. Only thing is that they will enter into environment slowly over a period, but the amount of greenhouse gases will be exactly same, but you are entering by burning that residue. Therefore, the solution is that let it go to that route. Let us take that greenhouse gas part as an energy, and bioslurry goes back into fields. Now, problem of farmer, that why this farmer agitation is happening in those pockets which traditionally has been most prosperous, where per farmer income has been at least 2 times compared to what was all India kind of average, where poverty among farmers is less than 1%, whereas all India average of poverty among farmers in 11-12 was 20%. Why it is happening there? We looked into it, we thought about it. The reason is that income from agriculture in that state are not now increasing because they are growing only rice and wheat. No doubt they have highest productivity of rice and wheat, but they don't have highest productivity of crop sector. Brother Sahab, I will share my paper with you where I will show that the Punjab now comes at number 4 in terms of what is the productivity of crop per hectare. Because productivity of fruit and vegetable compared to field crop at all India level is 7 times. We get output worth 1 lakh from 1 hectare from cereal, pulses and edible oil. From fruit and vegetable, the average is 7 lakh. So if you diversify, you imagine how much income you will get. But thing is that for 3 generations, farmers are used to produce under a granted kind of price. So they don't feel comfortable that you are producing something for market. So I come from that state and I come from a farming background. I'm a farm. I go there every 2 months. Last Monday also I was there. So there are this kind of problem that we are not letting diversification happen there. Industrialization is also very slow. So still among all the states, the potential of diversification is highest in Punjab because of the fact that area and irrigation is 99%. Road network is so good, but even with best water, best road network, all those things, area under fruit and vegetable in Punjab is 1%. In Maharashtra with 18% of irrigation, you know how much area is under fruit and vegetable. So solution lies in diversification and agro-based industrialization, but this will not happen in vacuum. It requires overall change in the policy framework. That is the ultimate solutions. Since those things are not happening, farmers are seeking increase in their income through price increase, which everybody knows is not sustainable. So there is a solution, again, as I said at the end, but we need to work on several fronts to provide that solution.
Thank you. Thank you, Dr. Chand, Dr. Denning. I think this has been a very, very engaging and insightful discussion. And I like to also thank all the participants for being here. I think as Dr. Chand said in the beginning, it's extremely encouraging to see such a significant participation at the fag end of the day and at a subject which has not generated so much of interest in the past. But nonetheless, it's a subject that is very critical to the nation's success. It is the backbone of the nation. It can have transformative influence on the economy in many ways, rising income, consumptions, natural resources. So the multiplier effects are tremendous as far as this sector is concerned. And that's the key takeaway from this whole, the very strong message from this discussion today. And once again, thank you, Dr. Chand, Dr. Denning, for this being here and for your very, very insightful comments. So may I suggest a very, very warm applause for the panelists.
Thank you, Mr. Puri. May I request you to kindly hand over a token of appreciation to both our guest speakers. May I also request all three of you to please step forward for a photo opportunity, please. Ladies and gentlemen, with that we come to a close of the first day of the Global Economic Policy Forum 2024, organized by the Ministry of Finance and the Confederation of Indian Industry. Can I have a round of applause, not just for the speakers on the dais, but for the audience itself. Thank you very, very much. You've been a great audience. Look forward to meeting you again tomorrow. Please join us for dinner before you leave. Thank you. Thank you very much for being with us. See you here once again tomorrow. Thank you.